Hi students, welcome back to the Financial Management Marathon class for the June 2026 attempt. Myself, Fatema Kagalwala, I have designed this marathon for the important topics from your exam point of view. So all the concepts along with the formulas and then the illustrations with the past exam questions which will help you clear this attempt with flying colors and revise your entire financial management with me. Okay, so the sums which we are going to solve over here, they are absolutely those types which are going to be asked in your exam. So this is it what you have to revise. You have to just stay with me. Okay, we are going to do it topic wise. In each topic we will solve everything with the past exam questions and we will complete all the important topics which will help you revise. Okay, so now let's begin. So these are my notes and I have also solved the problems along with the I've given you solutions also. So these notes, okay, will be there in the description. Okay, the link will be given in the description of the video. It is also available on our website on the free material and free sources tab, so you can avail it from there also. These notes were going to be very helpful. I have solved past exam questions also in this only. Okay, and it is chapter wise, so you'll be able to easily figure it out, all these revision notes. Okay, so let's begin now. Leverages chapter, okay, for our financial management. Now leverages, very interesting chapter, okay, very practically used, okay, in today's financial management decision levels. Okay, now what is this financial management? We all know when we talk about financial management, okay, accounting, fine, everybody now you can read your P&L, you can do your you can read your balance sheet and cash flow statement and understand the profit loss, etc. But management is not concerned with P&L, etc., right? They want to know how are their financials working in order to give a good growth in the business and do a strategic planning for future. Okay, so they know their P&L, balance sheet, cash flow and all. They are more interested in getting those type of information from the raw data which will help them analyze each and every factor which is affecting their business, their profits, their revenue, turnover, etc. Okay, so leverages, what does leverage help? How does leverage become a core part in financial management? Is it helps in understanding a relationship between two variables. Okay, a relationship between two variables. Now that relationship is very important for us to understand. Why? Because see, if I'll tell you that we have made sales, only then there will be a profit, na? Or if there are a lot of expenses, you will tell me that there will be a loss. So there is a relationship, okay? When there is sales, when there is you are doing a turnover, and because of that turnover you have also incurred some expense in order to get that turnover, whatever is left with you is the profit. So there is a relationship between the profit and the sales. Okay, I can keep a particular thing that if 100 rupees is my sales, I at least want 10% of profit on that. So there are two variables. One is an independent variable and one is a dependent variable, that is a factor. Okay, so leverage is to understand how much will that dependent factor change if that independent factor, upon that independent factor, change in that independent factor. So how much change in profit will come if today I change the amount of sales, because they are two related with each other. So relationship between sales and profit is what we are going to see in leverage. Whether if I increase 10% sales, will it amount to 10% increase only in the profit? We need to check. It is not compulsory. Why it is not compulsory? Because what happens is that, say for example, okay, in case of sales, there is always something known as variable cost. Okay, so variable cost varies depending upon the sales you have made. Okay, the amount of sales you will make, it will be a direct proportion or ratio of that sales, 60%, 40%. In our case, it is 40% of sales. It is directly relatable variable to sales. Okay, so variable cost is there. So I will say there is a contribution profit over here 60, but there are some costs which are fixed in nature. How much ever sales you make, you either make 1 rupee sales or you make 100 rupees of sales, it is always going to stay the same. So say my fixed cost is 30 rupees. So now my profit is going to be 30. So how much ever change I make in sales, okay, how much ever change I make in the sales, say now I change the sales and I have made it 120, means there is a 20% increase. Okay, so 120 into 40%, right? 120 into 40%, that will give me 48. So my contribution will be 72, but my fixed cost is going to remain the same. Okay, so my profit is going to be 42. So how much did my profit change from 42 to 30? Right, 12 rupees. 12 rupees my profit changed when there was a change of 20 rupees in the sales. My profit has changed by 60%. See, profit has changed by 60% when I just increased my sales by 20%. So not necessary that if the sales is increasing by 20%, profit will also increase by 20%. Why? Because there is this fixed cost which is involved over here. Same thing I can say for the decrease. If the sales have decreased by 10%, does not necessarily mean that profit will also decrease by 10%. So leverage is to understand how much profit will change because of the change in sales and due to the fixed cost which is involved. Okay, simple. This is what you all have to understand. Okay, so say if sales goes up by 1% and profit is increasing by 4%, I will say my leverages is 4. And say thus, if the sale will go up by 5%, okay, when sales is going up by 1%, my profit is increasing by 4. So say if sales will go up by 5%, how much will my profit increase? Cross multiply. 20%. Why? Because the leverage itself is 4. So when the sales will drop also by 1%, my profit will also drop by 4%. So higher the leverage, higher the risk. Okay. So the more the fixed cost, higher the leverage, higher the risk. Okay. So you should always, that is why the companies, they do these leverages in order to understand where they can, minimize their fixed cost and what all changes they can bring so that the leverage is not at a very high risk. Okay. Now, in leverages, there are 3 things. Okay, 3 important types of leverages from your exam point of view. Leverages is more practical based chapter. Okay, it is a part of your capital structure from your module, but it is more on practical side. Okay, so you all do not have to really worry about theory. Certain things, yes, for theory you have to just do those theory which will be important for us to solve the sums. Okay, so as I told you, leverages is to understand the relationship between the 2 variables. Operating leverage is when we understand the operating expense. It is related to the operating expense. Financial leverage, it is relating to the financial expense which is interest. And combined leverage means it is operating leverage into financial leverage. Okay, both together. Now before I do this, I will first take you all to the income statement. Then we will come here. Income statement. Once we understand the income statement, for us leverages will become easy. Now income statement, like say I made sales. Okay, from sales, I just showed you all, we remove the variable expenses and we are left with an amount which is known as contribution. From there, we remove some fixed expenses. In that, we are left with earnings before interest and tax. Now, this earnings before interest and tax, you remove interest, you get net profit before tax. You remove tax, you will get net profit after tax. Then the number of equity shares which are there, you divide that profit from with the help of that number of shares, you get earning per share. This is the income statement. Okay. Now operating profit. Okay, operating profit is basically talking to you about the operational expenses, okay, and not relating to financial. So operating expenses is between them. See, operating expenses, one is your after your contribution, okay, there is fixed expenses, right, and then there is one financial expense which is interest. So operating leverages is between contribution and EBIT, a relationship between contribution and earning for interest and tax. And financial leverage is the relationship between earning before interest and tax and NPBT. Why? Because interest is between them. Okay, so now we will come to the leverages theory thing, so we will be able to understand. Okay, yeah. Degree of operating leverage. Degree of operating leverage means what? Operating leverage can be defined as company's ability to use the fixed operating cost, fixed costs. Okay, so that they can magnify the effects of changes in the sales on its earning before interest and tax. Okay, so degree of operating leverage is a change in EBIT with the change in sales, percentage change in EBIT upon percentage change in sales. EBIT is a dependent factor and sales is an independent factor. How much will my earning before interest and tax will change? Upon percentage change in the sales. Or simple, with the help of the income statement, it is nothing but contribution upon EBIT. As I showed you all in the income statement, we will take contribution. Okay, sales minus variable cost, we get contribution, minus fixed cost, we will get EBIT. So fixed cost is in the between. Okay, so contribution upon EBIT will be my degree of operating leverage. Okay, now if I tell you that my degree of operating leverage is 1.33 times, what does that mean? That EBIT is more sensitive with respect to the changes in the sales. Means what? If degree of operating leverage they are saying is 1.33 times, that means contribution upon EBIT they have solved and they are getting 1.33 times. Means what? If the sales will increase by 10%, then EBIT will increase by how much? 10 into 1.33, 13.3 times. If sales will decrease by 10%, so it will decrease by 13.33. If increase, profit will increase. If there is a decrease in sales, their profit will also decrease. That is the simple meaning of degree of operating leverage. Okay, change in the operating income because of the change in the sales. Same thing is with the financial leverage. Financial leverage is the ability of the firm to use fixed financial charges. Like say you have taken a loan, you have issued debentures, there is an interest factor which is involved. Okay, so how much profit are you able to earn after even absorbing this interest cost so that you can give a better earning per share? Okay, so long-term fixed interest bearing debt and preference share capital along with the share capital is called the financial leverage or trading on equity. Okay, so favorable financial leverage occurs when company earns more on the assets with its funds. So it will be a positive financial leverage. Okay, whenever percentage change in earning per share resulting from a given percentage change in EBIT is greater than percentage change in EBIT, financial leverage exists. Means what? This means as long as your degree of financial leverage is greater than 1, there is a financial leverage. It is good. Okay. So what are financial leverage? When you take, long term loans, debentures, preference dividend, etc. So the change in EBT or earning per share, okay, upon percentage change in NPBIT or EBIT, or simple NPBIT upon NPBT will be the degree of financial leverage. This is what we need to remember. NPBT. Some companies may or may not have the financial leverage based on whether they have got interest as a cost or no. Okay, they might be totally loan free. Okay. However, financial leverage helps us in tax benefit. Okay. Companies obtain debt capital, then companies leverage that capital to purchase some assets. Company use assets then to increase the profits. And degree of combined leverage is nothing but degree of operating leverage into degree of financial leverage. What is degree of operating leverage? It is contribution upon NPBIT. This is degree of operating leverage. Degree of financial leverage, it comes between NPBIT. Interest comes between NPBIT and NPBT. Na? NPBIT cancel. Contribution upon NPBT. That will be your degree of combined leverage. A simple multiplication or this formula which we need to understand, and that is percentage change in the earning per share, the last one, due to percentage change in the sales. Okay, this is degree of combined leverage. Okay, now coming to your question. Okay, let us understand one question. We will be able to solve the sum now. There is this statement given for Zenith Limited for the year ended 31st March. Sales 10 lakh 50, then there is a variable cost 7 lakh 67, fixed cost 75, earnings before interest and tax is 2 lakh 8, interest 1 lakh 10, taxes at 30%, net income is 68,600. We have to find degree of operating leverage, financial leverage and combined leverage. Okay. So, if I make my income statement, best is to make the income statement in order to solve these type of problems. Okay, when we make the income statement, our entire problem is solved. See, sales they have already given, variable cost is given. So, I came to know my contribution here. Sales minus variable cost, everything is given to us. We don't have to worry. Minus fixed expenses, here they have given me fixed cost 75,000. I'll get my NPBIT. Minus interest, again they have given. NPBIT also they have given. Interest I'll minus, NPBT 98,000. Okay. Less tax, and if you want you can continue further, but I want only these three leverages. So what does this three leverage? Degree of operating leverage. Okay, operating leverage means we are talking about the operating expense, right, which is your fixed expense. It is between contribution and NPBIT. So, you will be able to remember the formula. It will be contribution upon NPBIT, 2 lakh 83 upon 2 lakh 8,000, 1.36 times. Then, degree of financial leverage, we are talking about interest. It is between NPBIT and NPBT. So, the formula will be NPBIT upon NPBT, 2 lakh 8 upon 98,000, 2.12 times. Degree of combined leverage, just multiply both of them, 2.88 times. Okay, so all these my solved notes are also there, as I told you on the link. You have to just take it from the link. It is there in the description of the video. Okay, so your time will not get wasted and you will be able to quickly revise. So this was very basic. Okay, so and you get this type of sums, okay, in exams. It can be a combined sum with other chapter like capital structure, but you will get this type of sums only. Find operating leverage, financial leverage or combined leverage. Okay, come on. Now a little bit twisted sum. They have given us sales, Sunrise Limited sales, variable expenses at the rate of 35%, which is 1 lakh 40. When you minus, you get contribution, less fixed tax expenses, you get EBIT, less interest, we get taxable income 70,000. Means they have made the income statement and given it to us. Okay. Now they are saying you are required to submit the following information to the management of the company. What percentage change will the taxable income increase if the sales is increased by 6%? They are asking us relationship between sales and taxable income. Sales and taxable income is involving both the costs, fixed as well as interest, operating and financial. So I will use degree of combined leverage in order to find this change in the taxable income. Next, they are saying what percentage will EBIT increase if there is a 10% increase in sales. So they are saying what will be the change in EBIT if there is a change in the sales. That means they're talking about only fixed expense. So here now I am going to use degree of operating leverage. Okay. And last, what percentage will taxable income increase? Okay, if EBIT increases by 6%. So they are talking about this two, relationship between these two. So there is interest which is involved. So I will use degree of financial leverage. Okay, these three degrees of leverages, I'll be able to find it out with the help of the income statement. Okay, so now let's see. Yeah, using leverage to find out the increase or decrease in the profit. First, I am using the degree of combined leverage for my first one because they are asking me how much my taxable income increase percentage if my sales is increasing by 6%. Okay, so first I'll find my degree of combined leverage. What is degree of combined leverage? Contribution upon NPBT. So contribution they have given me 2,60,000. Taxable income is 70. It is given everything over here. Okay, so this will be 3.714 times. Okay, now make the working note. Write sales and NPBT. We need relationship between these two, na? So they are saying if sales, well, we have already found out, if sales is increasing by 1%, my NPBT is increasing by how much times? 3.714 times. This we just found out. They are saying what will be the change if sales increases by 6%. So if sales is increasing by 6%, cross multiply 6 into 3.714. Simple multiplication. Okay, so it will be 22.284. You can directly also multiply 6 into whatever times, degree of combined leverage you have got. Next they are asking what percentage will EBIT increase if there is 10% increase in sales? Okay, so for this I will have to use, I told you, degree of operating leverage. What is degree of operating leverage formula? Contribution upon NPBIT. Contribution they have given it to us. NPBIT also is given to us 80,000. 2,60,000 upon 80,000, 3.25 times. So sales and NPBIT relationship we are searching, okay, finding out. So if sales will increase by 1% or change by 1%, there will be change of 3.25 times in NPBIT. They are saying sales is going to increase by 10%. Okay, so 10%. So how much NPBIT will increase by? Cross multiply or simple 3.25 into 10, whatever percentage they have given. So it is going to become 32.5%. This I have done working note so that you understand the concept behind applying the formula. You just don't have to remember the formula and keep on mugging it up. Understand application of basic, things which we have to use in your financial management, day-to-day financial management if you go in a company, and understanding these type of ratios. Okay. So, and formulas. So, this is basic. Okay. Sales increasing by 1%. We already found out if there is a change in sale by 3.25 times the profit is going to change by. Right. So, they have told me sales is changing and increasing by 10%. So, how much it is going to change the profit? 32.5%. Lastly, they are saying what percentage will taxable income increase if NPBIT increases by 6%. Okay, so now I'll have to, for NPBIT and taxable income. interest is involved in them. Only this thing is there. So what is my degree of financial leverage formula? NPBIT upon NPBT. NPBIT is given, NPBT is given. I found out the degree of financial leverage. Now they are saying NPBIT increases by 1%. Okay, so NPBIT increases by 1%. NPBT changes by 1.4. If NPBIT changes by 6%, as they have told me, increases by 6%, how much will NPBT change by? Cross multiply. Okay, or 6 into 1.14. So it is going to be 6.84%. This is it with the leverages. Okay, they are going to ask you either 3 leverages or they will ask you the change in the relationship between the 2 variables. Okay, and it can be a combination with along other chapters. Alright, so in leverages there is past exam questions, but I want to first explain you all the other chapters so that when we solve the combined question you will know the concepts of the other chapters also. Alright, so financial leverage, operating leverage and degree of combined leverages. This was it with your leverages. Now, alright, okay, so now we are going to begin with cost of capital chapter. Okay, now in cost of capital also I have already solved my sums, so you all don't have to again worry about this. Okay, the sums are already been solved. Come. Okay, now for cost of capital, just a basic understanding I will give you that what is this cost of capital and where do we use it in financial management. Okay, now capital, we all know capital is of 2 types. Basic thing I am showing you all. Okay, own and owed. Own means your own capital in house, okay, which can be in form of equity share capital or it can be in form of preference share capital. And owed means either you have issued some debentures or you have some loan, etc. So in your owed capital you basically have interest. Here you have dividend paid. Correct? Right. So in case of a company, okay, think from the company point of view. Okay, company, whenever they are going to have a particular capital, either own or owed, there is a cost, which is involved. This dividend is a cost, for the company to pay. Say if I am telling you the dividend rate is 8%, for preference share capital it is 10%. Okay, interest is again 12%. So all this is what? It is a cost to the company, right? So say if my project, okay, for which I need capital, is going to give me a rate of return, okay, interest, rate on investment, return on investment at the rate of 15%. Okay, and my cost of capital, total cost of capital is coming 10%. I will be able to make the decision, no, yes, I can accept the project. Accept the project. Why? Because I will make a profit, no, at least of 5%. Here, some benefit, right? So when there is a return attached to an investment or project, obviously a company takes up any project or takes up any work or does any operation, there is a return, no, on the investment, which is attached to the cost. So whenever you are doing cost of capital, okay, in that matter in financial management or in corporate accounts, one main thing is that you think from the company point of view. Then only you will be able to solve it and you will never go wrong. So when, say, if you are running a company, you will obviously want to know what is going to be your cost of capital total. Why? Because you are going to use that capital for this project. This project is going to give you this much of return. You will compare, no, the return with the cost. Only then you will take up anything, right? So cost of capital, in this chapter we are going to understand, okay, the cost, okay, to raise the money, how much cost is going to be involved, the total cost, whether we will be able to provide that minimum, rate of return which is there in the investment. Okay, so say if the cost of capital is 10%, return on the project is 12%, I will of course accept it. But if cost is 10% and return is only 8, I will not take up that project. Okay, so capital, two types, owned and borrowed, equity, preference, debentures and loans. Okay, now see this illustration. Company has started the business with rupees 10 lakhs. Now this 10 lakhs is in different sources. Okay, sources means own or mixture. Okay, 10 lakhs is not directly some equity capital or direct loan. Okay, there is a breakup of this 10 lakhs. 5 lakhs is kept as equity share capital is there. Then we have 10% debentures, amount is 3 lakhs, and there is some preference share capital 2 lakhs rupees where the 12% is the preference dividend. So that makes total 10 lakhs. Okay, now they have told you the cost. For equity, the cost is 20%. So on 5 lakhs, if I do 20%, it is 1 lakh rupees. Then 10% on debentures interest you have to give. So 10% on 3 lakhs is 30,000 rupees. And 12% on 2 lakhs, because 12% preference share, no? So 12% is the rate of dividend, 24,000 rupees. So 1,54,000. Divide that by the total capital, 10 lakhs cost is 1,54,000. Right? You divide that by 10 lakhs. So you will get 15.4% as your overall cost of capital or total cost of capital. Or else you can do it as per the weighted average cost. Equity, debt and preference total 10. Assign weights. Assign weights means what? How? 5 divided by 10, 0.5. 3 divided by 10, 0.3. 2 divided by 10, 0.2. Cost is already given to us. Multiply the weights by the cost. So 20 into 0.5, 10. Then 0.3 into 10, 3. And 12 into 0.2 is 2.4. When you will add this up, 10 plus 3 plus 2.4, you will get weighted average cost of capital 15.4%. Okay, if the project has, okay, return on the capital employed as 12%, then it should be rejected. Okay, so the project which yields above this cost only can be accepted. Obviously, you cannot accept it otherwise, because you are not going to gain anything out of it. It will be total loss. Okay, now here all these costs were given. Cost of debt was given, preference share is given, equity share capital is given. But in the sums, we will have to find the cost. Okay, we'll have to find the cost of the debt. We have to find the cost of the preference share. We have to find the cost of equity in that matter. Okay, it is a little different. Now, cost of debt is resembled by and written as KD. Cost of debt is nothing but interest 1 minus tax rate. Why interest 1 minus tax rate upon the price into 100? Okay, if you want it in the form of percentage. Why 1 minus tax rate? Because of interest, right, your net profit before tax decreases. Since this decreases, the tax also on this will decrease. If there is no interest, your NPBT will be higher. Okay, so when I say NPBIT, okay, minus I do interest, then I get NPBT. Then I will do tax. Because of the interest, you get tax benefit. Tax is less, okay, because it is as a percentage. Therefore, interest minus tax benefit will be your actual cost of the debenture and not that 10% of interest which you are paying. Because you are paying interest, you are saving on the tax now. So calculate that also to know the actual cost. So your cost of debt will be nothing but interest minus tax rate, or you can simply do interest 1 minus tax upon the market price. If market price is not given, we will take the price like 100 rupees of face value. Okay, so there is only this simple formula, cost of debt is nothing but interest 1 minus tax rate. Okay, if face value is 100 and here also multiplying, so this will get cancelled only. Unless market price is given, we will take the market price. Okay, this is the formula. But sometimes the debt comes with along with the life. So in that case, the formula is the same only, interest 1 minus tax rate. But when the time of debt is given, that means the life is given, you will have redemption value. Okay, you will have some price of redemption value. Upon, how will you find the actual cost? You had to give something at the time of redemption, whether you did redemption at par or at premium or whatever, minus the sales value upon number of years of the life of the debentures, upon what will be the price, RV plus SV upon 2, average of both. Okay, so this is one formula. When the life of the debt is given, we are going to solve this kind of a sum. Now with preference dividend, cost of preference share is nothing but preference dividend upon market price. Okay, now DDT is not actually there, so we will say preference dividend upon market price only. Now if the life of the preference share is given, same thing, it will be dividend plus RV minus SV upon N. This is like a capital gain, no? Upon RV plus SV upon 2. The average of both the prices. Okay, so in case of debt and preference, there is not much formulas, only 2 formulas. If life is not given, simple formula, dividend upon the market price. Okay, and interest 1 minus tax rate for cost of debt. For equity, there are different types. Okay, it is money invested by the promoters. Okay, the returns can be in form of dividend, the returns can be in form of increasing in the capital, it can be in the form of increasing in the market price, So cost of capital, equity share capital can be found out in different manner. First is if you are finding out based on the dividend, so it will be D1 upon, so your KE will be nothing but D1 upon P0. If they are given you earning per share and based on earning per share you are doing, then earning per share upon PO. And if it is dividend plus they are giving you some growth, so dividend upon PO plus the growth rate, whatever it is. And the last one is your CAPM model, which is a capital asset pricing model. This I will show you at the time when we will do security analysis. Okay, I will take you all to the formula. Right now we will do this 3: dividend, earning per share, dividend plus growth model. Now cost of reserves is nothing but your opportunity cost. Okay, you have kept some money in reserves. Means what? If this you would have put in something else, you could have bought some other machine or some other kind of a project, so that would have cost, no? So your opportunity lost is your opportunity cost, correct? So the cost of retained earnings is actually similar to that of cost of equity. Okay, unless opportunity cost, if it is given, then you take that as a cost of the reserves. Otherwise KE and KR will generally remain the same because it is the reserves belong to the equity shareholders. Okay, now weighted average cost of capital. Weighted average cost of capital means what? KO. It includes cost of debt, cost of equity, cost of preference shares and cost of retained earnings. Okay, so how do we solve it? Say example, they have given me equity, preference, debentures, loans and reserves, value 2 lakhs, 3 lakhs, 1 lakh, 1 lakh, 3 lakh, and the cost is also given to me. Okay, so now the sources, all these 5 sources, 1, 2, 3, 4 and 5. So total becomes 10 lakhs. I have assigned weights to them. Okay, so 0.2, 2 divide by 10, 3 divide by 10, 1 divide by 10. So 1 divide by 10 and again 3 divide by 10. So weights are given. Cost is already given to us, 10, 8, 6, 5 and 3. So we just did know previously also. So weighted average cost of capital will now be 10 into 0.2. Remove that percentage sign. Don't multiply 0.2 into 8% and all that. Just say 10 into 0.2. Simple. 10 into 0.2. 8 in, because all these mistakes you all do, and then you will come back to me saying that ma'am, we are not getting the answer. Okay, so basics, these are, understand how to solve maths. This is okay. So 6.4 is the weighted average cost of capital. All right. Now in the exams, they will generally tell you to find the cost of capital either based on the book value, that is your face value, 10 rupees share, 100 rupees debentures, or else they will give you the market price and then they will tell you to find the cost of capital, which is your KO, based on the market value. Where the price of the debenture, say it will be 102 in the market price, then the equity share is 25 rupees. Okay, because they are listed in the market. So then you will have to do it as per the price of that share or that debenture into the number of shares or number of debentures which is there. Okay, book value means the basic thing which we have just done. But market value, then we have to take care of the market price. Okay, now see this. A and company has the following capital structure: 10% debentures, they have 10% preference shares and 5,000 shares of rupees 100 each. Total is 10 lakhs. Equity shares of the company are quoted at rupees 102 and the company is expected to declare a dividend of rupees 9 per share. Assuming tax rate is applicable to the company at 50%, calculate the weighted average cost of capital. Okay, now this solution I will solve it over here only. Okay, it is going to be very easy. See, now first I will need all the cost. First I will have to find cost of debt. What is cost of debt? Interest 1 minus tax rate. Okay, upon price I have told you, into 100. Right? Now interest is how much? 10% interest. Minus tax rate is what? 50%. No, so convert that, make it 0.50. What is the price have they given? I will assume it to be 100 face value. 100. So this and this will get cancelled. So 10 into 0.5. Right? Correct? So it is going to be 5% cost of debt. Cost of preference shares, nothing, it is going to be the same thing. Okay, cost of preference share will remain the same thing. It is preference dividend upon the price. What is the preference dividend? 10% means 10 on 100 rupees. So this is going to remain the same. For equity, cost of equity, it is how much? The company is expected to declare a dividend of 9 rupees. So D1 upon market price. D1 is 9 rupees, market price is 102 into 100. 8.82%. Right? So I got all the cost. Now I have to find the weighted average cost of the capital. So I will write your equity share capital. Okay, so I'm just solving this as a rough. Okay, equity share capital, preference share capital and debentures. Right? How much is the equity share capital? Total 5,000. 5 lakhs. 5 lakhs, 2 lakhs and 3 lakhs. Okay, equity share capital is 5 lakhs. Preference share is 2 lakhs. And then this is 3 lakhs. So total is 10 lakhs. Okay, I will assign the weights 0.5, 0.2, 0.3. And what is the cost of capital? Equity, it is 8.82. Preference is 10. Debt we got is 5. Multiply each one of them. Okay, 0.5 into 8.82. It will be 4.41. This is going to be 2. This is going to be 1.5. Okay. So 1.5 plus 2 plus 4.41. It is going to be 7.91. Weighted average cost of capital. Answer. Easy. Okay, now we will do the market value weights. Both. We will do book value weights also and market value weights also. See, determine the weighted average cost of capital using both book value and market value, and they ask this type of sums in the exam for 5 marks. Why 5 marks? Because everything is given over here. You have to find it only the KO. We have to find what? KO based on book values and then based on the market price. That's it. Cost of each component they have already calculated and given it to you. Cost of debt, cost of equity and cost of preference shares. Okay, so now let us first do book value. In case of book value, price is 100, 100 and equity is 10. Okay, so book value weights here. Sources, debenture, preference share and equity, 8 lakhs, 2 lakhs, 10 lakhs. I am just writing the given as per the book value. Book value 8 lakhs, 2 lakhs, 10 lakhs. Weights I will assign 8 divided by 20, correct? Then 2 divided by 20, 0.1, 10 divided by 20, 0.5, 0.4, 0.1, 0.5. Cost is given 7.4, 14.87 and 17. Just multiply them. You will get the weighted average cost of capital, add 12.803%. For market value weights, okay, amounts will change. See, I have marked a star. You will take all the 3 sources, debenture, preference share and equity share. But now the amounts will change. Why? Because they are saying that the debentures market price is 110 per debenture. So how many debentures are there? 8 lakhs debenture amount. Divide that by 100, which is the face value. So there are 8,000 debentures. There are 2,000 preference shares. Okay, and then there is 1 lakh of equity shares. 1 lakh. So now debentures amount will become what? 8,000 into 110. Preference share will be 2,000 into 120 and equity share will be 1 lakh into 22. Okay, so this will be the amount. 8,000 into 110, 8 lakh 80. Then 2,000 into 120, 2 lakh 40. And 22 rupees into 1 lakh will be 22 lakhs. So total will be 33 lakh 20,000. Now you will do the weights. Okay, so 8 lakh 80 divided by 33 lakh 20, 0.2651. Right? Then 2 lakh 40 divided by 33 lakh 20, 0.0723. And then again last 22 lakhs divided by 33 lakh 20,000, 0.6627. Cost is already given to me. Just multiply. You will get weighted average cost of capital for each debenture, preference, equity. Add them 1.87, 1.075 plus 11.269. Okay, I'll get weighted average cost of capital as 14.21%. Okay, number of shares or debentures into the market price per share you will take for the market value weights. Okay, come on. Let's see the past exam questions, whether what I'm saying is right. Okay, first one. Magnum Limited is manufacturing industry which has a mix of equity and debt to finance its business. Company is growing at a considerable rate, promoting the management to go for expansion. The company is considering various alternatives to raise the funds for the same. So they have 12% debentures as a first issue. Then they did a second issue of debentures which is 13% interest, 10% cumulative preference share capital and equity shares face value 10 rupees. Retained earnings is 1,50,000. Additional information. Equity shares are sold in the market at rupees 25 per share. That is the market price. Company is contemplating to declare a dividend of 3 rupees at the end of the current financial year. The company has a practice of paying all the earnings in form of dividend. Okay. 100 rupees per debenture is in the first issue. They are to be redeemed at par and has 12% of flotation cost and 8 years of maturity. Market price is 120. Second issue of the debentures, again rupees 100 each. It is redeemable after 5 years and are currently selling at 90 per debenture. This is also the market price. 100 rupees per preference share is they are redeemable at par and they have 3% of flotation cost and 10 years of maturity. The market price of this is 108. Tax rate is 30%. Shareholders' tax liability may be assumed at 25%, whereas the capital gain tax is 20%. Okay. The CFO of the company is keen at understanding the cost of capital. Accordingly, you are appointed to complete the following tasks. Find out the weighted average cost of capital using book value weights and market value weights. Further, the company also intends to know the market price of the equity shares at the end of the current year using M&M approach along with citing the assumptions of the theory. Now, this M&M approach is in the dividend policy, okay, to find the price of the shares as per M&M approach. But I will show you all it is a simple formula. We will again do it in the dividend policy. It will become more clear. Assuming the company has a sales of rupees 20 lakhs, variable cost is of 12 lakhs, fixed cost is 5 lakhs excluding interest. Calculate operating leverage, financial leverage and combined leverage. Very nice. Okay, so we'll solve this sum. Come on, I've already solved it for you. Okay, to find weighted average cost of capital, I will begin with finding the cost of the first issue debentures. Okay, they have given me the tax rate 30%. So interest 1 minus tax rate. I know it, but my debentures are with a term. Okay, first debentures are for 8 years. The second issue debentures are for 5 years. So my formula will be what? Interest 1 minus tax rate. Plus I told you RV minus SV upon N, that is number of years. Divide that by the average price, RV plus SV upon 2. So cost of debentures for the first issue, interest is given 12%, tax rate is 0.3. What is the redemption value? They have told me they are to be redeemed at par. Redeemed at par means they will get 100 rupees. Flotation cost is there of 2%. That means my sale value actually, it is going to be on 100, there is a cost involved. So minus 2%, that will be 98. Why? Because there is a flotation cost of 2%. So on 100 rupees, minus 2% will give me 98 upon number of years, which is 8. Divide that by 100 plus 98 upon 2. Okay. Flotation cost, these are all the costs which are incurred at the time of issue of the debentures. Okay, so your value actually for that particular debenture was 98 rupees. There was a flotation cost also involved, and average is 100 upon 98. 100 plus 98 upon 2. Now 12 into 0.7 you will do 8.4, and 100 minus 98 upon 8 will be 0.25. Divide that by 99. Your KD for the first issue is 0.087. Same concept again apply and do it for the second issue. For second issue, the interest rate is 13%. Okay. Then the redemption, okay, redeemable after 5 years. Okay, so now interest 1 minus tax rate. Okay, redeemable after 5 years. Have they given what is the redemption values? That means it is going to be at par if nothing is given. Rupees 100 each, na? So 100 rupees at par. Nothing is given about the sale value, etc. So again the same thing, 100 minus 100 means at the time when the debentures were issued, you got 100 rupees. Okay, company got it. At the time of the redemption, you are going to give back 100. Right, so there is nothing involved, there is no cost, nothing involved over here. So 100 minus 100 upon 5 is the life of the debentures. Divide that by 100 plus 100 to get the average. Divide that by 2. Okay, so at the time of issue, okay, at the time of issue price, you can say redemption price and issue price. If you are not comfortable with SV, you can say issue price also. So it was 100, redemption value is also 100. So 13 into 0.7 will give you 9.1 plus 0 upon 100. So cost of debentures second issue is 0.091. Okay. Next is preference shares. Okay, for preference shares, they are redeemable at par and they have 3% flotation cost. Okay. So now for debentures also, preference dividend, for preference shares also, preference dividend plus RV minus SV upon N upon RV plus SV. Okay, preference dividend is 10%. Redemption is at par, they have told me. Redeemed at par, that means 100 rupees is the redemption value. What was the issue value? It had carried 3% flotation cost. So 100 minus 3% flotation cost, no? So here it will be 100 minus 3%. Okay, divide that by number of years. The life of the preference share is 10 years, therefore divide by 10 upon the average price. How will find the average? RV plus SV upon 2. Okay, so 10 plus 0.3, because 3 upon 10, divide that by 98.5, you will get 0.1046. So cost of preference is also done. Cost of equity. Cost of equity is simple. I can just take this D1 upon the market price formula. D1 they have given it to me. 3 rupees given. Both is given. 25 rupees market price is also given to me. Don't do it into 100. Keep it in the point form only. 0.12. Okay, now in case of cost of reserves, retained earnings, okay, they have given you the opportunity cost. Okay, it is hidden here. See, shareholders tax liability can be assumed as 25%, whereas the capital gain tax is 20%. Okay, so entire reserves, we say that it belongs to the kind of entire reserves are of the equity shareholders. So nothing, if it is given, KE will be same as KR will be same as KE. But here for cost of reserves, this will change a little. What is happening is they are having a practice of paying all the earnings in the form of dividend. Okay, and shareholders having a tax liability of 20% and capital gain tax of 25 and 20%. So what will happen is that 3 rupees dividend which they are going to get, they have to pay a tax of 0.25. So 1 minus tax rate. And the market price which they will gain, there will be a capital gain tax. So 1 minus 0.20. So this is an exceptional thing which was asked in the sum. This can be asked again, so do it properly. Okay, marginal tax rate, okay, for the shareholders, and the capital gain tax on the market price. So market price is 20. So this KE formula will now change. It will be dividend 1 minus 0.25 and 25 1 minus 0.20. So 2.25 upon 20. Now the KR is going to be changing. It is going to be 0.1125. Very minute different, but there is, because there is a tax rate involved in this case. Okay, shareholders tax liability. So if they get paid dividend, their tax liability is attached. And capital gain tax is tomorrow you sell the shares in the market, 25 rupees. So it's your capital gain, you will put a tax rate of 20% there. Okay, and the reserves are basically given in form of dividend only. So that is how I am taking this cost of retained earnings. Everything is found out now. I will take the book values and the amount. So I am keeping this table ready. Starting with equity shares 6 lakhs, 10% preference shares 2 lakh 50, Okay, so this is done. Then this is the first issue, 12% debentures, 13% debentures, retained earnings. Weights, total is 15 lakhs. So 6 divided by 15, 2.5 divided by 15, like that you will do, you will get the weights. Cost, we have already calculated for each of the source. Okay, so weights into cost, you will get the weighted average cost of capital. You will add them all, it will be 0.1063. Now you can convert that into percentage, okay, by multiplying by 100. 0.1063 into 100, you will get 10.63%. Same thing again, all the sources, I'll take the amounts as per the market value weights. Okay, so how many debentures I have? It is 100 rupees face value, no? So 3000 debentures, here 2000 debentures, preference share 2500, equity shares will be 60,000. Okay, now market value weights, how will I get when I have the amount based on the market price? So for equity shares, 60,000 shares, 25 rupees is the market price. It's given here. Here, all the market price I'm going to highlight it. Okay, market price of equity share. Then we have market price of the first debentures, market price of second debenture, and market price of the preference shares. Okay, so first debentures, okay, preference share 108 into 2500. Sorry. So 2,70,000. Then first debentures is 3000 debentures into 120 is the market price, 3,60,000. Second debenture 2000 into 90 rupees is the market price, 1,80,000. Retained earnings will remain the same. Now the weights will change. Okay, it will be 15 lakhs divided by 24,60,000. So weights, it will change. 0.61 I have converted into 2 decimals, nearest closest. Okay, so weights, you will have to calculate the weights. Just divide 15 lakhs divided by 24,60,000, 2,70,000 divided by 24,60,000, 3 lakh. Do it properly. Okay, don't make mistakes here. This is basic using of calculator. So cost will be all that which I have found out. Multiply that, you will get your weighted average cost of capital. So there is not much difference, but see, it will be somewhere close by only, because market values were also not very high or low as compared to the face value. So 11.09 is the weighted average cost of capital as per market value weights. Okay. Now they are saying, as per M&M method, find the share price, equity share at the end of the current year. Now generally, if I want to find the price, no, without M&M method, I will just apply this same formula. KE will be D1 upon PO. I want to know the price, so price will go on this side, D1 upon KE. I know KE, na? KE I found out, na, 0.12. Cost of equity here. See? Here I found out, na, 0.12. So this I can just put it and I can find the answer. It will be 25 rupees. It is given in the sum also, 25 rupees. Now see this M&M approach. In M&M approach, P1, okay, P1, price 1, okay, will be nothing but PO, the previous price, means the actual price today. P1 is the current year's price, price tomorrow, P1. PO is the base price. PO into 1 plus KE minus D1. This is the formula for your M&M approach. So PO, they have given us market price today. Then 1 plus 0.1212 with this KE we have found out. D1 is also given by them. So when you solve this, 28 minus 3, you will get 25. This we are going to do in M&M approach once again. The current market price, which is P1, this is your base price. Okay. Then assumptions of M&M hypothesis theory, that is a theory question. You have to refer it from your, answers. Now calculation of leverages. This is interesting. Assumptions of the theory. This is a small theory. This is a good 20 marks question. Okay, so means out of 40, your 20 is covered over here if you do it everything right. And M&M approach assumptions of the theory, 5-6 points are there. That's it. Okay, now leverages. They are telling me sales is 20 lakhs, variable cost is 12 lakhs. Okay, so sales given, variable cost given, so contribution is 8 lakhs. Okay, fixed cost is 5 lakhs, this is also given, so NPBIT is 3 lakhs. Interest, I do not know. They have told me fixed cost excluding interest. So what will be my interest amount? See this. From here only I can calculate. On 3 lakhs, 12%, and on 2 lakhs, 13%. See, there are two debentures, no? 36,000 here. 26,000 over here. No? 62,000. Interest. Right? So see this. Okay. So interest 36,000 plus 26,000. One is your 12% debenture and one is your 13% wala debenture. Right? So 62,000 will be your interest. NPBT. Tax rate is given to me 30%. So my profit after tax is 1,66,600. My income statement is ready. They are asking me degree of operating leverage. Degree of operating leverage means they're talking about this fixed cost. So contribution divided by NPBIT. Degree of financial leverage, that means they're talking about interest, NPBIT upon NPBT. And degree of combined leverage, just a multiplication of both. See, contribution upon NPBIT and NPBIT upon NPBT. 2.67, 1.26 multiply. Degree of combined leverage is 3.36 times. Nice. Good sum, na? June 2024. Come on. Now one easy sum. Okay. 5 marks. This was 20 marks. Everything was there. Financial leverage, operating leverage, M&M theory, and cost of equity, cost of your reserves, retained earnings. Okay. Now operating XYZ Limited. Okay, we have some information. Operating profit is 105 lakhs. Then there is interest on debentures. Okay, so 105 minus 3372. Then income tax at the rate of 30%. So your net profit is 50.4. Equity share capital rupees 10 each. So you have 200 rupees, 200 lakhs in form of rupees. So you have 20 lakh shares. Number of shares. Reserves and surplus 100 lakhs, 15% non-convertible debentures of rupees 100 each, 220 lakhs. Market price of the equity share is 12 and of that of debenture is 93.75. Calculate earning per share, percentage cost of capital for the company for debentures, funds and the equity. Now earning per share we will be able to do it because we know how to make the income statement. Okay. First I am finding the earning per share. Earning per share will be profit after tax, which is already given to me. 50.4 in amount is in lakhs. So 50 lakhs, 40,000. How many shares I have? 20 lakh equity shares. So earning per share is 2.52 per share. So my cost of equity, earning per share, I could find out. Market price is given to me 12 rupees. This is given. Earning per share we just found out. Right. So 2.52 upon 12 into 100, 21% is KE. Cost of debentures as per book value. Interest 1 minus tax rate upon price. Book value is 100 rupees. So interest 1 minus tax rate. Interest is 15% here given to me. Tax rate is how much? 30%. So interest 15, 1 minus 0.30, so 10.5%. And as per the book market value, interest 1 minus tax rate upon market price. 93.75 is the market price into 100. Okay, so 15 into 0.7 divide that by 93.75%, 11.20. So KD is 11.20. The earning per share is done. Percentage cost of capital for debenture and equity, both I did, book value as well as market value. Easy, both the sums. Okay. So this was with the cost of capital. So remember, in cost of capital you all are supposed to do cost of debentures, cost of equity, cost of preference shares, okay, and cost of retained earnings. Okay, generally all the formulas have only one formula. Only in equity you have earning per share, dividend, and dividend plus growth model. Okay, based on that you are supposed to find KE, and with that you are supposed to find the weighted average cost of capital. Okay, so cost of capital clear with past exam questions. Okay, so this is how you all are going to go about and solve it. Okay, now again for this cost of capital, okay, this is obviously, as I have been telling you, it is an important chapter, right? Now cost of capital, this cost of debentures, okay, so we were solving the sums when we have already solved it though, but just since it is an important topic, it is important from your understanding and exam point of view, I am just kind of explaining it to you. That cost of capital, and in that cost of debentures, one is when life is not given. Okay, life is not given. We did those basic sums where we say cost of debt is nothing but interest into 1 minus the tax rate upon the price. But when life is given, okay, these type of questions have been asked. That is why I am emphasizing on revising this type of cost of debt question. Okay, so now in this case what happens is, when the life of the debenture is given, okay, so say when debentures are basically issued for a given period, say it can be issued for a period of, say, period of 10 years. Okay, so I issued here and I am going to redeem them in a period of 10 years. This is how basically the debentures life, issue price, redemption price, everything is discussed. Okay, it is there. So when the debentures are given a life, they will have a issue price. Say I tell you the issue was at 100 rupees and the redemption happened at 120 rupees. So then here the cost of debenture actually will change. Why? Because there is a gain which has happened between the issue and redemption of 20 rupees. But it has not happened in single year. Okay, it took 10 years for this gain to take place. So obviously your cost of debenture will be, of course, we are doing this interest into 1 minus tax rate. But along with that, we have the capital gain which has happened is 20 rupees. So your redemption value minus your issue price upon this particular thing has happened over a period of 10 years n. And what will be the price now? We will take the average RV plus IP upon 2. Okay, so cost of debenture when the life is given, this will be the formula. Now this issue price and redemption price, there are different terms used. Okay, so we can talk about like redemption price as the maturity price, redemption value as a maturity value. Okay, and issue price is IP, correct? Your net proceeds, that means your gain. Net proceeds is nothing but the gain which took place. Okay, so your maturity value minus your basically your issue price. Okay, so that will be important for us to calculate. That is the net proceeds. Like I received 120, I had invested only 100 rupees. So that 20 rupees is my basically my income, which the capital gain, okay, which got to me after I had got my redemption money from the investor point of view, and from the company point of view, this is going to be the amount which you are going to give over and above the face value or above the issue price. Okay, so the formula is simple: interest 1 minus tax rate plus the maturity value minus the issue price upon n. Okay, divide that by maturity value plus net proceeds is when you had issued. At that time, how much of money you had taken from that debenture holder, that is the net proceeds. Okay, divide that by 2 into 100. Now, why do we basically, sometimes when you issue debentures, there is a cost, okay, which is involved in issue of debentures. There can be cost like discount is involved at the time of issue. So that is why they are saying net proceeds. Okay, just let us take one example. SK company issued 10,000 10-year 8% debentures for rupees 100 each at 4% discount. So the face value, okay, face value is 100, but when the issue happened, okay, issue was done at 4% discount. So basically the net proceeds which was received by the company by this issue was 100 minus 4%. Correct. So that is going to be 96. These are going to be redeemed. So the redemption value, or you can say the maturity value, is going to be 5% premium. So on the face value of 100 rupees, if I am adding 5% premium, 105 will be my maturity value. And the period is 10 years. Okay. Cost of the issue involved was again 2%. At the time when the company didn't issue, they had to bear some expenses, which is 2% again, and the tax rate is 50%. So then how will we calculate this particular question? Simple. Interest 1 minus tax rate. Okay. So annual interest is, we know it is on 100 rupees on the face value into 8%, which is 8 rupees. Net proceeds, as I told you, 100 minus 4, that will be 96. But there is some issue related expenses, 2%. So 2% of 100 is going to be 2 rupees. Correct. So net, actually the net proceeds will now be 94 rupees. And maturity value we just calculated 105 rupees. All this is now to be just put in the formula. So it is interest 1 minus tax rate given to us is 50%. So it is 0.50. 0.5 plus this is the maturity value minus the net proceeds. Divide that by number of years. The whole thing is divided by the average of maturity value plus net proceeds upon 2 into 100. Okay, so 8 into 1 minus 0.5, it is going to be 0.5 into 8, 4. 105 minus 94, divide that by 10, you will get 1.1. Divide that by average of 105 plus your 94. It's going to be 105 plus 94, divide that by 2. 99.5 into 100. So now my cost of debenture is going to be 5.13%. Okay. Right, so we have solved these earlier. I am again repeating it and emphasizing it because they generally ask this type of questions. Okay, so maturity value, redemption value, say, you know, like they can also ask you they can give you terms like issue price, net proceeds. So these are all the same thing, same formula, right? Question number 2. SK company issued 1010% debentures of rupees 100 each. So this becomes my face value. Now issue has happened at 5% premium. So when the company did the issue, the proceeds received by them. Okay, so the issue price is nothing but 100 plus 5% premium, 105. Correct? Maturity is 10 years. Cost of issue is 2%, tax rate is 50%. Now there is also on this face value, okay, 5% premium understood, but there is a cost involved here. Okay, so there is a cost of issue which is 2%. That is again 2 rupees. Correct. So what will be my net proceeds? It will be issue price, which is 100 plus 5%, 105 minus 2 rupees. It is going to be 103 rupees will be my net proceeds. Okay. Correct. And my maturity. Okay. Maturity is 2 tax rate. So maturity price is not, that means they must have redeemed it at 100 rupees only. Okay, issued at premium and redemption at par. Right? So annual interest is of course 10% of 100 rupees, which is the face value, 10 rupees. Net proceeds will be 105 minus 203. Maturity value is not given. That means they were redeemed. The redemption value is the same as, it's at par as the face value. Okay. So now same formula if we will apply, we will get interest 1 minus tax rate. Okay. Plus your maturity value minus your net proceeds. Divide that by number of years, which is 10. And average is 100 and plus 103 upon 2 into 100, because we want the cost in percentage. So 5, because 10, 1 minus 0.5 will be 5. And when you will do 103, 100 minus 103, it will be 3 divided by 10. That will be 0.3, but it will become a minus sign. Plus and minus, because 100 is less minus 103. So now this will become minus. Plus and minus becomes negative. Divide that by 101.5 into 100. 4.7 divided by 101.5. The percentage will be 4.63%. So when you open the brackets, okay, so the sign has to change. Remember that. Why? Because here your maturity value is less than your proceeds which you took from the debenture holders. Okay, so when we think from the company point of view. So your final answer is 4.63, right? Same thing is for the cost of preference shares. Okay, when the life is not given, we are doing the basic, okay, dividend upon price. But when the life of the preference share is given, same thing falls here. Redemption price of the shares will be given. Okay, that at what price did we redeem? Because even preference shares come with life. 5 years, 10 years, 7 years. So redemption value at what, like maturity value. So at what did we, what price did we redeem the debentures? When the time of issue of the preference shares, what was the net proceeds we received? And same thing, divide that by the average of the price. Okay. So it will be dividend, annual preference dividend, the whole into the basically, your capital gain from your, you had in like from an investor point of view, it is a capital gain, because I had invested, say when we took this, I invested 100 rupees for this preference share, and when the redemption took place, the company gave me 120. So for me, that 20 rupees is again for the investor. For the company, it is like a cost, no? They have to give this extra 20 rupees, no? Correct? So D is your annual preference dividend, RV is redemption value, net proceeds. Net proceeds is nothing but your issue price minus any kind of expenses you did for this particular issue, and then number of years. So say face value of the preference share is 100, dividend rate is 10%. Okay, your net proceeds they have already calculated and given you. Redemption value also they have given you, life 5 years. Okay, so dividend rate is 10%. That means dividend will be 10 rupees. So D plus RV minus your net proceeds upon life is 5 years. So 100 minus 95, 5 upon 5, 1. Right? Apply the formula upon the average price into 100, obviously, because we do cost of preference shares also into 100. So 11, when you will solve this, you will get 11 upon 97.5 into 100, 11.2 28 is the cost of preference shares. Okay. Now coming to one very important topic, cost of retained earnings. See, all this while when nothing was given, we always assume that whatever is the cost of equity will be the same for the cost of reserves, because after all these reserves belong to the equity shareholders. Okay, so cost of equity, whatever is that cost, we apply that same cost for the cost of reserves also. But say they have given you certain more details. They are telling you there is some personal income tax of the investor involved, brokerage is involved, capital gain tax is involved. Then the formula for the cost of reserves changes. Now why so? Understand this. Say suppose I am the investor. Okay. I have received a dividend of 10 rupees. Correct? I have already received a dividend of 10 rupees. Now, based on this dividend, obviously the company has already deducted whatever dividend distribution tax in case and given me the balance amount of the dividend to me. So, I received this from the company. I am the investor. Okay? I am the investor. I am the shareholder, basically. So I received this dividend. Now I will have to pay, no? When I'll receive the dividend, I will have to pay my personal income tax, because after all this is the net income. So there will be income tax payment involved in my receipt of income. Correct? So say I paid some income tax of 2 rupees. From this 10 I paid 2 rupees of tax. Now I will not keep this 8 rupees with me. No, I am going to go ahead and invest it somewhere. This is what I am, an investor. So I am going to invest it. So obviously there will be some brokerage which will be involved. Say 1 rupee was the brokerage. So basically the gain will be net only 7. Correct? And today, whatever is the market price, say I had taken the share in 10 rupees. Today, the market price is standing at rupees 25. Okay, so whatever is the market price, this extra 15 which I am getting, okay, extra 15 which I am getting, that will be my capital gain. So, on that capital gain also, I will have to pay the tax. Okay. So cost of reserves for the company is something which on the dividend, okay, say there would have been involved a personal income tax, also the brokerage. So on that 10 rupees, I will put 10% of say personal tax. Then I will also put some brokerage on that 10 rupees which is going to be there, and the market price. On that, I will have some capital gain tax which will be kind of imposed. Okay. So, keeping all these particular things in mind, the cost of reserves here will now change. Okay. So, dividend is the income that shareholder would have received if profits were distributed. Retained earnings is what? Companies keeping that money and not giving the dividend. That is the meaning of my retained earnings. Retained earnings. Companies keeping them, or we say it as reserves. Say company would have not kept this as reserves and given this in the form of dividend to the shareholders. Then what would have happened? Obviously, there will be some amount required to invest in the shares. This is the market price. MP is the market price amount required to invest in the shares. T1 is the personal income tax, capital gain tax, and B is the brokerage cost incurred while again reinvesting. I would have taken this dividend amount and gone ahead and reinvested. Okay. So what does this, what does it explain? Like, basically that actual income which is available will be reduced by T1. T1 is the personal income tax and brokerage. Okay, so the shareholder will receive the dividend, then they will pay the personal income tax, reinvest that amount and incur brokerage and earn return, but on the sale pay the capital gain tax. So all this cost should be factored to find the cost of reserves. Okay, so basically what is the interpretation? Net income available after dividend, tax and brokerage upon the effective investment adjusted for the capital gains tax. Okay, so basically when both personal tax is given, capital gain tax is given, cost of retained earnings will be calculated by adjusting dividend and brokerage and investment for the capital gain tax. So let us see one example. Dividend is 10 rupees. Market price of this share is 100. Okay. Personal income tax on that dividend is 20%. Capital gain tax is 10%. Brokerage is 5%. Okay. So now what happened is, say 10 rupees dividend I got into 1 minus personal income tax rate, which is 20%. So 1 minus 0.2. Then I will also have to pay the brokerage into 1 minus 0.05, because 5% is brokerage, means 0.05. Now this amount I am left with, I will go ahead and I will obviously I will have to kind of invest. Okay, I have to reinvest. No, so the market price for my reinvestment is 100. On that, capital gain tax will also be implied. Correct? So 1 minus 0.01, capital gain tax is 10%. So 10 into 0.8 into 0.95, 7.6 upon 100 into the capital gain tax, which is 10%. Okay. So 1 minus will be 0.90. So all this into 100, it will give you the final calculation of retained earnings. Okay, so after adjusting the dividend tax, brokerage and capital gain tax, the shareholder effectively earns 8.44%, which becomes the cost of retained earnings for the company. This is what the shareholder would have earned. Whatever the shareholder is earning is the cost for the company. All right. So this particular from entire cost of capital, we have already done the other chapters, we have already done the other sums regarding weighted average cost of capital, finding each cost of capital for cost of equity, reserves, etc. So if all this information is given regarding personal tax, capital gain tax, brokerage, then cost of reserves will be solving it in this manner. And if the life of preference shares and life of debentures is going to be given, then we are going to apply this particular formula and solve the sum. Okay, just be careful regarding the plus and minus sign when you open the bracket. Okay, so thank you everyone, and all the best. So now, since you all know and understand the income statement, you all are understanding leverages, you know how to find the cost of capital. So now the financial management, the managements are now like having the faith that we will be able to get an optimum capital structure for the organization, or advise or suggest that what should be the proper capital structure for the business in order to take up a project or grow the business, expand, etc. Okay. So what is a capital structure? We know the sources. It's a mixture. It can be some owned, some own capital, owed capital. So there can be bigger chunk of equity share capital. You have some debt. You have some other sources. You have a preferred stock, that is preference share capital. Okay, so capital structure, which will be the best for this particular organization, for this particular project? What should be the optimum capital structure? How much should be the equity, or how much should be the debt, or how much should be the preference share or loans, or how much you should use as your reserves? So that is what we are going to understand in the capital structure, the breakup of the capital employed of the firm. Okay, so how much is the owner's capital and how much is the lender's capital? Okay, it is a reflection of the overall investment and financial strategy of a given company. Okay, now these are some theories. You all can just go through it and read it. Okay, various kinds of capital structure, just read. Now, why do we need a significant capital structure? What are the significance? It is the firm strategy. It is the indicator of risk profile. Okay, it acts as a tax management tool and improves the image of the firm. So now what is an optimal capital structure? It will be that only, where there is a balance and ideal debt equity ratio. There has to be a balance. What will be optimal for any company? Where there is a balance of equity, balance of debt. The debt equity ratio is at a good, is a good ratio, and the firm's cost of capital is less. Okay. See, in theory, debt financing generally offers lowest cost of capital. Why? Because there is a tax benefit available. No? If you will have debt, you will have a tax benefit. So generally, financing by debt will give you a lower cost of capital. So optimal capital structure is that situation which functions as a benchmark of the performance, okay, of a company. Now, see, okay. So, type 1. Okay, just to evaluate. Okay, there are different types in capital structure. So now first type is to understand that if there are different options given to us, which option we will choose, which one is considered to be the best. Okay, so in this type of sums, they will give you the present capital structure. They will tell you that this is our capital currently. Then they will tell you that we need some 5-10 lakhs extra now for a particular project. And now tell us from which particular, option do we choose. Whether we do full equity or equity debentures or debentures and preference shares, etc. or mixture of above. So see this. ABC Limited, we'll solve one sum so we'll get an idea. ABC Limited has an equity share capital of rupees 5 lakhs. Face value of each share is rupees 100. That means there are 5,000 equity shares currently. To meet the expenditure of an expansion program, company now wants to raise rupees 3 lakhs. They are having 4 alternative sources of funds. They can either do it in form of full equity, again this 3 lakhs extra. They can have 1 lakh from equity and balance 2 lakhs they can do borrowings. Interest rate will be 10%. They can take full money as a borrowing, 10%. 1 lakh in equity and 2 lakhs preference shares at 8%. The company is having present NPBIT as 1,50,000 and tax rate is 50%. Suggest suitable option to raise the fund. The company wants the same return as earlier. Whatever return they were getting earlier, the rate of return should not change. Okay. So, okay. So, in this question, they have given me my earnings. Okay. 1,50,000. They have given me my corporate tax rate and they have told me that the rate of earlier return means has to remain the same. Okay. You have to choose that suitable structure. That means my profit should not change. My return should not change. So with my present capital employed, which is 5 lakh rupees, currently this much is employed, 5 lakhs. I was earning a profit of 1,50,000. That means how much is the return? 1,50,000 divided by 5 lakhs. Percentage 30% is the rate of return on capital employed. This is what I am earning. I want to earn the same rate of return, 30%. But now capital employed will be 8 lakhs. Why? Because I need 5 is there plus 3 I need extra. So 8 lakhs. So how much profit I'll have to earn on 8 lakhs? 30%, that will be 2,40,000. So my NPBIT will be 2,40,000. Based on that, I will do my capital structure and my income statement. Okay. So there are 4 options. Option 1, 2, 3, 4. NPBIT we just found out 2,40,000 we will need. Okay. Now your first option is full equity. Okay. So your number of shares will now become 8,000. 5,000 shares plus 3,000. Your second option is equity share is there only 5,000. Okay, then you are doing debentures, no? 1 lakh from equity and 2 lakhs from the borrowings. Okay, so now your equity share will be 5,000 plus 1,000, 6,000 shares. Third option, there is no equity, full is borrowed money, so your 5,000 equity shares will remain. And in the last is again 1 lakh equity and preference shares balance. So again your equity shares will be 5,000 plus 1,000. Okay, so 3 lakh equity only, 1 lakh equity, 2 lakh debt, 3 lakh only debt, 1 lakh equity, 2 lakh preference shares. These are the 4 options. You can write this above, okay, if you all want. Now in my first case, devised NPBIT is 2 lakh 40. There will be no interest, no, because the entire funding of the 3 lakhs again I am doing through the help of equity share capital. So my NPBT will remain 2 lakh 40. Tax rate given 50%. Net profit after tax will be 1 lakh 20 minus preference dividend. Then the profit will be available for equity shareholders. Net profit after tax, if there was no preference dividend, it will be then the same thing. But here we will have preference dividend in our fourth option. Correct? So 1 lakh 20 minus preference dividend in our first option is nil. Number of shares is 8,000 and net profit for equity shareholders is 1 lakh 20,000. So my earning per share in my first option is rupees 15. Now next one. In the next option, 1 lakh is equity and 2 lakhs is debt. Okay, so 2 lakh 40,000 is NPBIT. Interest will be like what? Interest will be 2 lakhs debt, na? On 2 lakhs debt, they are saying there is 10% rate of interest. So 20,000 will be my interest amount. So here 20 will reduce it. So 2 lakh 20. Tax is 50%. So directly 1 lakh 50. So net profit after tax is 1 lakh 10. So no preference dividend. So this is the amount available for equity shareholders. Divide that by number of shares. That is 6,000. So you get 18.33 as earning per share. Next, 2 lakh 40 again. Full entire 3 lakhs we are doing in form of a debt with 10% interest. So 10% on 3 lakhs is 30. 2 lakh 10 is my net profit before tax. Minus 50% of tax 1 lakh 5. So profit after tax is 1 lakh 5. There is no preference dividend. So this is the amount available for equity shareholders. Divide that by number of shares, which is 5,000. My earning per share is going to be rupees 21. And in the fourth option, 2,40,000 is the NPBIT. There will be no interest. So NPBT will be the same minus tax 1 lakh 20. There will be a preference dividend. Why preference dividend? Because 2 lakhs you are taking it in the form of preference share at 8% per annum. This. So 2 lakhs into 8%, you are going to pay 16,000 as preference dividend. So profit available for equity shareholders 1 lakh 4,000. Divide that by number of equity shares will be 6,000. So you will get 17.33. So you see, amongst all the 4 options, the earning per share is highest in the third option. Therefore, you will say the option 3 must be selected since the earning per share is the highest. And even in theoretically and practically, if you will see, wherever there will be a debt, because of the tax benefit, you will automatically get earning per share higher because that many number of equity shareholders are also less, na? Here, because of the fresh equity share issue, number of equity shareholders increase. So there are 2 things because of which in this type of alternatives, you will get the best earning per share. Okay. Now, there is a second type in this. There can be that amount of profit. Okay, understand. Okay, the shareholders can tell you that you select any option, we have no problem. Okay, you need no shareholders approval when you go ahead for this expansion plans and take more money and making all these options available, what should be done. So obviously you will need your shareholders opinion. Okay, there can be that level of earning per share. Okay, that level of EBIT, sorry, that level of earning before interest and tax, that level where your earning per share will remain the same only whether you go for debt or any other option. So here it is known as EBIT EPS indifference point. So you select any option, shareholders will have no problem. They will be indifferent. They will say, okay, fine, our earning per share is not getting affected, because that amount of profit wherein both is giving the same earning per share, then it is fine. So in your questions, they can ask you to find that profit at which your earning per share will remain the same. So your formula will be EBIT minus interest, 1 minus tax rate minus preference dividend upon n, equal to EBIT minus interest, 1 minus tax rate minus preference dividend upon n. So this will be, say, for your earning per share 1. This will be your for earning per share of second option. It is derived from the income statement only. EBIT minus interest, okay, then EBT minus tax, okay, profit after tax minus preference dividend. Okay, so profit available for equity shareholders, divide that by number of equity shares. That is how you get earning per share, na? Earning per share formula only this is. Okay, so let us understand one question. A new project requires a capital outlay of rupees 300 lakhs. They required the funds by either full equity shares of rupees 100 each or equity shares of rupees 200 lakhs of 100 each and loan of 100 lakhs. So first it is full equity, that means full 300 lakhs equity, and in the second one it is 200 and 100. Okay, 15% will be the rate of interest, tax rate 50%. Calculate the figure of profit before tax. Profit before tax. That would keep the equity investors indifferent with the two options. Verify your answer by calculating the earning per share. Yeah. So your profit before tax of EPS 1 has to be same as EPS option 2. In EPS option 1 it is equity. EPS option 2 here is loan plus equity. Okay. So in my first option, X, EBIT is X. Interest will be 0 only because there is only equity. Only equity. This is loan plus equity. Tax rate is given 1 minus 0.5. There is no preference dividend, so 0. Divide by how many shares it will be? In my first case, 300 lakhs rupees. Divide by 100 rupees share each. Okay, so 300 lakhs divided by rupees 100 each is the share value. So 3 lakh shares. N is number of shares. Okay, next. In earning per share 2, option 2. Earning per share option 2, it will be EBIT. Interest will be there, no? Why there will be interest on 100 lakhs of loan? 15%. So 15 lakhs interest. Okay, 1 minus tax rate 1.05. Preference dividend is 0. How many number of shares will be there? 200 lakhs only. 2 lakhs only. 200 lakhs divided by 100 rupees. 2 lakh shares. So 2 lakhs. Okay, now we have to solve this. 1 minus 0.5 will be 0.5. EBIT minus 0 will be EBIT. This is 3 lakhs rupees. This is solved. Now this you have to solve. Okay. This is going to be 0.5 of EBIT. 0.5 into EBIT. And then again 0.5 into 15 lakhs, which will be 7,50,000. So 0.5 EBIT minus 7,50,000 upon 2 lakhs. Right. Now this 2 lakhs I have taken it over here above. So this zeros and these zeros got cancelled. So 2 into 0.5 EBIT. 2 into 0.05 EBIT is equal to 3 into 0.5 EBIT minus 75,000. I have taken that into the bracket. Okay, this 3 I am taking it on the other side, and this 2 I am multiplying with 0.5 EBIT. It will become 1 EBIT. 3 into 0.5, 1.5 EBIT, and 3 into 7,50,000 will be 22,50,000. Now this minus 22,50,000, when I will bring it on the left hand side, it will become plus, and 1.5 EBIT, and this one when I'll take it on the other side, it will become minus. Okay, so 22,50,000, that will be, now this will become 0.5, no, 1.5 minus 1.5 EBIT. So 22,50,000 upon 0.5, that will be my EBIT. So EBIT will be 45 lakhs. Now this 45 lakhs of EBIT, you can put it in the statement and see, you will get the same earning per share in both the options. Okay, so these are 5 marks questions which can be asked in your sums, in your exams. Okay, now there is some type which is known as the market value of the firm based on your M&M approach. Now this is where I had left it, capital structure theory. Okay, net income approach theory, net operating income approach, and Modigliani-Miller approach. Okay, these 3 basic theories which we are supposed to do. Okay, so now what happens in these theories? Okay, in net income approach theory or MMM theory or net operating income approach theory, they say that there is no tax rate, there is no growth rate, only 2 sources are there, that debt and equity. Okay, these are the assumptions. No tax, no growth, only 2 sources are available, debt and equity, nothing else. So what will be the market value of the firm? Market value of equity plus market value of debt. That will be the market value of the firm. Okay, based on this we have to always find market value of the firm. Now since I am saying there are only 2 sources, market value of equity plus market value of debt will give me my market value of the firm. But how will I find the market value of my equity, and how will I find my market value of the debt? Okay, so market value of the equity is nothing but net profit for equity shareholders upon KE, and market value of the debt is nothing but interest, total interest upon KD. When we'll add this both, you will get the market value of the firm, and with that you can find the overall cost of capital, which is nothing but EBIT upon market value of the firm. Overall cost, how much profit you are earning and what is the firm's value in the market. Okay, so these are the formulas in which we have to understand. Now see this, assuming that there is no tax and KD is 12.5%, we have to calculate market value of firm ABCD from the following data. Also determine the weighted average cost of capital for each firm. Okay, so they have given me EBIT, interest and equity capitalization rate, 12%, 15%, 18%, and KD is common, 12.5%. Okay. So market value of the firm ABCD. They have given me what? NPBIT minus interest. So NPBIT minus interest, that will give me net profit for equity shareholders. So in case of A, it is 3 lakhs minus 30. So it will be 2 lakh 70. In case of B, 4 lakh minus 70, 3 lakh 30. And 6 lakhs minus 3 lakhs here, 7 lakhs minus 3 lakh 40,000, 3 lakh 60,000. This is the net profit available for equity shareholders, because there are only 2 sources, equity and debt. So preference dividend cannot be there only. So this is the amount available and net profit available for equity shareholders, and there is no tax also. So my income statement has become so small. Now since I got my net profit available for equity shareholders and they have already given me my KE 12, 15, 15, 18. So what will be the market value of my equity? I just told you the formula, no? NP for equity shareholders divided by KE. Such simple sums are there. So market value of the equity will be net profit for equity shareholders upon KE. So net profit is 2,70,000 divided by 12%. 2,70,000 divided by 12%. 3,30,000 divided by 15. 3 lakh divided by 15. 3,60,000 divided by 18%. Okay, don't forget to put percentage sign, only then you will get the market value. Okay, so it will be 3,30,000 divided by 15%, 22 lakhs. 3 lakhs divided by 15%, 20 lakhs. And 3,60,000 divided by 18%, 20 lakhs. Cost of debenture, they have already given me 12.5 for all. So for cost of debenture, it is what? Interest upon KD. Okay, in case of A, interest is 30,000. Divide that by 12.5%, 2,40,000. In case of B, interest is 70,000. Divide that by 12.5%, 5,60,000. Then for C, interest amount is 3 lakhs. Divide that by 12.5%. Oh, it is 24 lakhs. Market value of the debt. And last is 3,40,000. Divide that by 12.5%. 27,20,000. So market value of the debt is known. Market value of the equity is known. So for both, I am going to add, I am going to add market value of equity plus market value of the debt will give me the market value of the firm. So just total it. 22,50,000 plus 2,40,000. Total 22 lakhs plus 5,60,000. 20 lakhs plus 24 lakhs. And 20 lakhs plus 27,20,000. So KO will be NPBIT upon market value of the firm. We have found out market value of the firm, and NPBIT is also given to me. 3 lakhs, 4 lakhs, 6 lakhs, 7 lakhs. So for me now KO, cost of overall capital, weighted average cost of capital, will be for each one. I know the NPBIT 3 lakhs. Divide by market value of the firm is 24,90,000. Percentage 12.048. Similarly for B, what is the NPBIT? 4 lakhs. Divide that by market value of the firm, 14.49% you will get. And similarly for C and D. Okay. These are also the type of sums which they can ask for 5 marks. Okay. Now market value of the firm again. Okay, same thing, but there are two approaches, net income approach and net operating approach, okay, in which we have to find the market value of the firm. Okay, now what does this mean? Net operating income approach and net income approach. Okay, one of the variable will be missing. So whenever we have to find that, if it is a net operating income approach, NOI operating, their KO will be constant. Remember this, NO, net operating approach, KO will be constant. Net income approach, KE will be constant. Okay, what does that mean? Okay, now let us read us one question. See, market value of the firm, company X and company Y are in the same risk class and identical in all the aspects. Okay, except company X uses debt. Company Y does not use any debt. So the levered company, the one which uses debt, levered means using of the debt, has 9 lakhs debentures which carries 10% rate of interest. Each company earns 20% before interest and tax on their total assets of rupees 18 lakhs. Tax is 50%. KE for an all equity company is 18%. Calculate value of both the companies using NOI and NI approach. I will first do NOI approach where KO is constant. Cost of overall capital is constant. Okay. So company X is levered, company Y is only equity. Okay, so in debt and equity there are only two sources as per this approaches. So 9 lakhs they have it as 10% interest, and basic other 9 lakhs will be the equity because total 18 lakhs, no? So if 9 lakhs is in form of debt, so another remaining is 9 lakhs equity, and this all equity company 18 lakhs completely equity. Okay, so now NPBIT, they are telling that they have a return of 20% on their total assets. So on 18 lakhs they are earning 20%, which is 3,60,000. I found out my NPBIT for both the companies. minus interest, it will be in the levered company 90,000, no, 9 lakhs into 10%. Here there will be no interest, so net profit for equity shareholders is already calculated. I can find cost of equity, right? How will I find cost of equity? Market value, net profit available for the equity shareholders upon market value of the equity. But I do not know the market value of the equity because I don't know the KE. KE I don't know. For an all equity company, K is 18%, I know. Okay. So this I know. I'll just write all the givens. This I know. Okay. KD for my this company is 10%, this is 0. Market value of the debt will be how much? Market value of the debt will be total interest upon KD. How much is the total interest? 90,000 divided by 90,000 divided by 10%. 9 lakhs will be my market value of the debt. Okay, this I know. There will be no market value of the debt here because there is no this only now. Now, in case of the company which does not have any debt, okay, market value of the firm and market value of the equity will be the same because there is no debt, right? So market value of the equity, I can say, no, market value, see, if I am writing like this, I am saying market value of the firm is nothing but market value of equity plus market value of debt. So market value of the firm minus market value of the debt will give me market value of my equity, na? That also I can write. For a company which does not have any debt, for that the market value of the equity will be and the firm will be the same thing. So it is going to be 20 lakhs, no, market value of equity, right? Market value of the equity is going to be how much for them? It is going to be net profit available for equity shareholders. Market value for the equity will be net profit available for equity shareholders. That is what we do upon the KE, right? That is what we do. We know the market value of equity. It is going to be 20 lakhs only, na? Total. Okay. 1 minute. All right. Okay. 1 minute. Just once again, I will show you all. Okay. All right. So until net profit for equity shareholders, we are clear, right? All this was given. So 2,70,000, 3,60,000. Now we have to find market value of equity, market value of debt, and then the total we will get the market value of the firm. Okay, this is what they want. They want to find the value of both the companies. Okay, so basically we want market value of the firm. Now for market value of the equity, we need net profit available for equity shareholders upon KE. Okay, KE though we do not have. We do not have KE for this particular company where there is levered. KE for non-levered company, it is there 18%. So I am writing it. There is KD for the levered company 10%. So market value of the debt also I got for it. Okay, 9 lakh rupees. Now, KO, overall cost of capital, is constant. And in this approach, when we say NO approach, we assume KO to be constant. Okay, KO is constant means what? See, for a non-levered company, the cost of equity, KO, itself is going to be the KE will be KO. It will be the same thing, no? Because there is no debt. So KE, it is already given to me. So even overall cost of capital will be 18% here. Since we assume in NO approach that KO is constant, that means here also it has to be 18%. So now I know my KO is 18%. I know my NPBIT. KO is basically what? NPBIT upon market value of the firm. Right? I know my KO. I know my NPBIT. So with that I can find the market value of the firm. So market value of the firm is NPBIT upon KO. Right? NPBIT for company X is 3,60,000. Divide that by 18%. Right? Market value of the firm. So now this is going to be 20 lakhs. I have my market value of the firm. I have the market value of the debt. So balance is going to be the market value of the equity, 11 lakh rupees. That is why I put a circle. Now I have my market value of equity. I have net profit available for equity shareholders. So I can find my KE, net profit available for equity shareholders upon market value of the equity. Right. So it is going to be 2,70,000 divided by 11 lakhs. Percentage 24.54%. Okay. So this was your net operating income approach. We were able to find the market value of the firms. Now see this. Now net income approach. In net income approach, KE is constant. I am writing the details again. I am explaining you all also again. Now here in this case, KE will remain constant for both the companies. Okay, so debt is in the levered company 9 lakh rupees. Balance 9 is equity. So total it is 18 lakhs. In company Y it is all equity. So 18 lakhs, right? Profit we are making is 20 lakhs on this, 20% on 18 lakhs, 3,60,000. Interest in the levered company at the rate of 10%. So 90,000, 2,70,000 and 3,60,000 is the profit available for equity shareholders. Now KE in a company with no debt is given to me, is 18%. It is given to me in the question here. It is given. So since it is a net income approach, KE is constant. This is 18%. So this also has to be 18%. So now market value of equity is easy. Net profit available for equity shareholders, divide that by KE. So 15 lakhs and 20 lakhs. KD, it will be only for the levered company and nil over here. Right? So market value of the debt is what? Total interest amount upon KD. Interest amount is 90,000 upon 10%, 9 lakhs. So market value of the firm will be 15 lakhs plus 9 lakhs, 24 lakhs. And for this, it is going to be only 20 lakhs. Market value of the firm I have NPBIT. I can find KO now. NPBIT is 3,60,000 for both. 3,60,000 divided by that market value of the firm is 24 lakhs. So percentage is 15% here. And here 3,60,000 divided by market value of the firm is 20 lakhs. It is going to be 18%. Obviously, because it is a non-levered company. Right? So see how we can find the KO and KE based on the market value of the firm, assumptions and approaches. Okay, net operating approach where KO will remain constant, and net income approach so E will remain constant. Okay, so this is like one question for the net operating and income approach. Now based on that, I have done the past exam questions. Okay, these questions look really big. There are only 2 questions, but trust me, there is nothing in this question. So never get scared if you in exams. Trust me, the lengthier the question, it will be the easier to solve. Because they give you these big questions and you feel, oh my god, now what is this? How will I solve? Half of your confidence is gone there, which they want. Okay, so do not worry, don't get scared. It is not difficult. Read it nicely, point after point. Half of the history, geography, you don't even need it. You just need the numbers, numericals. Okay, now see this question. Okay, Metadex Limited is a clean tech startup focused on affordable solar energy solutions for urban households. They were founded by 2 engineers, Amit and Sumit, in 2021. Company developed a new solar panel design that is highly efficient and affordable. All history, geography they are giving you. The journey begins with Amit, an engineer working in traditional energy company. For years, Amit had seen damaging environmental impact on fossil fuels and the efficiency of the power grid. Concerned about the climate change and driven by the desire to make difference, he started researching on alternative energy solutions. Solar energy stood out to be an abundant and clean source of power that remained underutilized, especially in undeserved communities. In 2020, Amit quit his job and partnered with his friend Sumit in expert renewable energy policy and software engineer. Their vision is to revolutionize so and so, so and so. Starting the company was tough. They faced numerous challenges, including high upfront cost of solar panels, stiff competition of large companies, difficult in navigating government regulations. Okay, they initially struggled to secure the funding as many investors were skeptical of this renewable energy startup, etc. etc. Early stage solar hardware companies often require significant capital for research, development. Okay, so making it tough to sell to the investors looking for faster returns. So the company navigated through these initial stages of challenges, developed a robust marketing plan to target the eco-conscious communities, okay, partnering with influencers in the sustainability space. Okay, all right. Currently in this expansion process, Metadex needs around 15 lakhs. Here the question starts. To scale up their production and penetrate further in the market, Amit and Sumit decide to explore alternative fundraising options that will allow them to keep a control of their company and align with their long-term vision. So 15 lakhs is what they need. So they have given you the balance sheet. There is some fixed assets, current assets, equity share capital of rupees 10 each value, reserves, debentures, current liabilities. Okay. Currently, the EBIT is 8 lakhs, tax is 50%, market price of the share 25, market price of the debt, its book value and cost of equity is 14%. Okay, market value of debt is same as the book value and cost of equity is 14%. Financial advisors of Metadex assigned the task to calculate value of the firm and overall cost of capital before infusion, economic value added and market value added. The company has proposed to issue 8%, 5,000 preference shares of 100 each, and for the balance 10 lakhs it is considering two alternatives. So preference share is to there only. Other balance they want two alternatives: raise 90% of that balance by equity shares at the current market price and remaining 8% redeemable debentures 100 at par, or raise 80% by issuing 9% debentures at 100 par and redeemable after premium of 10% after 10 years and balance of equity shares at 33.33% premium. Again, the financial advisors asked to draft a financial capital structure, calculate earning per share and financial leverage. Okay. All right. In the books of Metadex Limited, okay, whatever they are given, I am writing it out. Okay, first I am finding the market value of the firm, because that is what they've told me. Value of the firm and overall cost of capital before infusion of funds. Okay, so on current basis, no? So I'll take all the current information. Earnings is 8 lakhs, taxes 50%, cost of equity 14%, all that I will take, okay? So NPBIT given 8 lakhs, less interest. Interest will be how much? Current I am seeing, no? 10% interest on 4 lakhs, 40,000. So profit before tax 7 lakh 60, less tax 50%, profit after tax, that is shareholders earnings, is 3 lakh 80,000. So market value of the equity will be the profit available for equity shareholders upon KE. KE is given 14%. So it will be 3 lakh 80 upon 14%. 2714,286. Market value of the debt will be interest. What is the interest amount? 40,000 divided by 10%, 4 lakhs. So market value of the equity plus market value of the debt will give me the market value of the firm. So KO, EBIT upon market value of the firm. EBIT is 8 lakhs. Market value of the firm we just found out in 225.69. So easy. overall cost of capital on the current base before infusion of funds. Now economic value added is very simple. How much value addition you have done, okay, based on the profit. Okay, so your net operating, what is economic value added formula? Net profit after tax, net operating profit after tax minus the cost of capital. Okay, weighted average cost of capital. So now that is how weighted average capital employed into WACC. We have to first find the weighted average cost of capital. Capital employed we know. Okay, how much is the capital employed? You can find out as fixed assets, which is 9 lakhs, plus working capital. Working capital means what? Current assets minus current liabilities. Current assets minus current liabilities. So how much it will be? Nine lakhs plus 5 lakhs, that is going to be 14 lakhs of capital employed. Okay, 14 lakhs of capital employed. Okay, otherwise you can take it from here also. 8 lakhs plus 2 lakhs plus 4 lakhs. Again 14 lakhs working capital and fixed asset, also the same thing, capital employed. Now we already found out, no, KO earlier, 25.69. So same 14 lakhs into 25.69, I'll get my cost of capital, and net operating profit is already given to me, 3,80,000. See, already told to me, no, your profit after tax. We just calculated. So 3,80,000 minus the cost of capital, 3,59,000. So my economic value addition is 20,340. This is from a different chapter, but they have added here. Market value of the debt is market value of equity shares, whatever will be the market value addition, MVA is nothing but market value of your equity shares minus total shareholders equity. Then add market value of the debt and minus the book value of the debt. So what will be the market value of the equity shares? We have how many shares? 8 lakhs divided by 10, 80,000 shares. What is the current market price? 25. Okay, so 80,000 into 25, that is your total market value of the equity shares. Total shareholders equity as per your books. How much is the shareholders equity? 2 lakhs plus 8 lakhs. Yeah, 8 lakhs plus 2 lakhs reserves and surplus is also there, no? So as per the book value, what is your shareholders equity? 10 lakhs. Correct? Okay, this 2 lakhs is the reserves and surplus. 20 lakhs minus 10 lakhs is 10 lakhs again. Plus market value of the debt. That's saying market value and the book value is the same of the debt. So market value of the debt is 4 lakhs minus 4 lakhs. Okay, so add 4 lakhs minus 4 lakhs. Same thing, 4 lakh gone. So market value addition is how much? 10 lakhs rupees. Okay, it is nothing but the market value of equity plus what is the equity value as per the book value of the equity with reserves and surplus. Okay, sorry, minus. And market value of the debt minus book value of the debt. So this whatever amount you will get, this was 10 lakhs. This became 0. So total is 10 lakhs. Market value addition. Okay, so this is done first and second. Now we have to come to the capital structure, 2 alternatives. Okay, now coming here. See, alternative 1 and alternative 2. Now when I'll do alternative 1 and alternative 2, I cannot forget the actual already existing which is there. Okay, I have an existing capital structure. Now I want to raise 15 lakhs. So in that another for 15 lakhs, then there is another options. Okay, so I start with equity share capital. Then they are saying preference shares to will be there only 8%. Okay, this 8% preference shares to will be there only. So 8% preference share capital. Then we have our reserves and surplus as per our balance sheet. See, reserves and surplus. Right, so that will be there. Then we also have this 10% debentures already existing, 4 lakh rupees. Okay, rupees 100 is the value. And in this case of two alternatives, okay, first alternative, we are raising the balance, means see, 5,000 into 100, so preference share capital is 5 lakhs. Okay, balance, for balance 10 lakhs, 90% is equity and the balance 10%. So that means 1 lakh will be debentures, right? 1 lakh will be the debentures. Of what percentage? 8% debentures of rupees 100 each. Here 8%. Okay, from that 10, 90 is going as equity. So from 10, 9 lakhs is equity. So 1 lakh is the debentures at 8% interest. So this is done. This is from the balance sheet. This is also from the balance sheet. Correct? Now, last one. 80% of the funds by 9% debentures. So 80% will be 8 lakhs rupees. So 9% over here, rupees 100 each will be the value. Okay, now for equity share capital, there are two now, alternative 1 and 2. Existing equity share capital is 8 lakhs. Okay, in case of first alternative, I am raising 90% of the funds of equity shares at current market price. So 90% means 9 lakhs I am issuing with the help of what? Current market price of the share, which is 25 rupees. So 9 lakhs, if I want to issue rupees 9 lakhs at 25, how many shares I will need? 36,000 shares. Market price, no, issue price is 25 rupees. How much money I am raising? 9 lakhs. So what will be the number of shares? 36,000 shares of rupees 10 each. So 3,60,000. So in alternative 1, my calculation of equity share capital will be 11,60,000. In my alternative 2, okay, equity share capital existing is so there only 8 lakhs. Balance, they are saying, in case of alternative 2, we are raising the balance 80%, that means 8 lakhs is with the help of debentures. So remaining 2 lakhs. Okay, remaining 2 lakhs I am raising at 33.33% premium. So what will be my issue price on 10 rupees plus 33.33%? 13.33 will be my issue price. So on 2 lakhs, 13.33. How many shares? 15,000 shares. Okay, 15,000 shares each. Okay, of rupees 10 each. So 1,50,000 will be my fresh issue. So 9,50,000 will be my equity share capital in alternative 2. Okay, 8% preference shares to rupees 100 face value they have given only. So 5,000 into 100, 5,000 into 100, 5 lakhs. Now reserves and surplus. Okay, now reserves and surplus in case of alternative 1, existing we know. Balance sheet in existing we already know that there is 2 lakhs. Right? No, we already know. But in alternative 1, we are going to do the fresh issue at a premium, no? Market price is 25. My face value is to 10 only, no? Market price is 25. So my premium is going to be, no, 15 rupees. That will go in what? Reserves and surplus. Fresh security premium, 36,000 shares into 15 rupees premium, 5,40,000. So 7,40,000 will be my reserves and surplus now. In case of alternative 2, existing 2 lakhs will be there. But now there will be a premium of 3.33 rupees. 10 rupees is the face value. Issue price is 13.33. So 15,000 into 3.33, 50,000, round it out. So 2,50,000 will be my reserves and surplus. So 7,40,000 and 2,50,000. 10% redeemable debentures existing, I have already written. 8% debentures as per alternative 1, it will be 1 lakh, and as per alternative 2, it is going to be 8 lakhs rupees. So total structure has now become of 29 lakhs. Correct? 29 lakhs. Now, with the help of this, so total structure we found out. draft the final capital structure. Now calculate the earning per share and we have to do financial leverage. Okay. So earning per share and financial leverage, we'll have to make the income statement. So NPBIT. Okay. NPBIT will be how much? 8 lakhs rupees. It is already given to me 8 lakhs. Minus interest. Now for interest, I will have to do the working note. Okay, why working note for the interest? For alternative one, existing, there is no 4 lakhs rupees 10%. That is there. For both the alternatives, this 40,000 is there. But as per the capital structure which we have done here, in alternative one, there is this one more, no, 8% debentures. So 8,000 that will get added, and 9% debentures, 8 lakhs into 9% that will get added. So see this. Alternative one, 10% on 4 lakhs and 8% on 1 lakh. 8,000 and 4,000, 48,000 for alternative one. Alternative two, this is existing, and 9% on 8 lakhs which is new. So 1,12,000. So for both, I will write here 48,000 and 1,12,000. So profit before tax will be 7,52,000, 6,88,000. Less taxes directly 50%. So 3,76,000, 3,44,000. Profit after tax I found out. Less preference dividend. There is only preference dividend is how much? On 5 lakhs rupees, I am going to give them 8% of the dividend. Okay, 5 lakhs into 8%, 40,000. So preference dividend for both 40,000 we will subtract. So net profit available for equity shareholders 3,36,000 and 3,04,000. How many equity shares are there over here? Number of equity shares, working note again. Here. Number of equity shares are over here. Okay, first it is 80,000 plus 36,000, na? 36,000 new shares, and there was already 80,000. Okay, so 80,000 plus 36,000. Here 80 existing plus 36, 1,16,000, and here 80 existing plus 15. We had already done, no? 95,000. So earning per share will be 2.9 per share in a case of alternative 1 and 3.20 in case of alternative 2. Financial leverage is NPBIT upon NPBT here. Okay, NPBIT is 8 lakhs and NPBT is, for option 1 is 7,52,000 and option 2 is 6,88,000. So my financial leverage will change. Now this financial leverage, we have done it without preference dividend. If we are doing it with preference dividend, okay, considering preference dividend as fixed bearing interest or fixed bearing dividend security. So NPBIT upon NPBT minus preference dividend upon 1 minus tax rate. Okay, that we have to do. Okay, so it will be NPBIT, we all know. How much is NPBIT? NPBT 7,52,000. Okay, so for your first option it will be NPBIT is 8 lakhs, right? NPBT is 7,52,000. How much is preference dividend? 40,000. 1 minus tax rate is 0.5. So 40,000 divided by 0.5, 80,000, no? So 8 lakhs divided by 7,52,000 minus 80,000, 6,72,000. 1.19. Same thing you'll have to do it for financial leverage with preference dividend, if we want to do, it will be 1.32. Okay, this is what they have given it in the guideline answers. So even I have solved it that way. Okay, if they ask you with preference dividend, this is going to be your formula, do not forget. Now next question, easy one, market value again. A company has EBIT of rupees 10 CR and belongs to a risk class of 15%, that is overall cost of capital is 15%, KO. What is the cost of equity capital if it employs 10% debt to the extent of 30%, 40% and 50% of the total capital of 50 CR? Assume net operating income approach applies. Net operating income approach applies means KO is constant. Okay. So now level of the debt is 30%, 40% and 50%. NPBIT. Net profit before interest and tax, they have already given me 10 CR. And KO is given to me, which is 15%. It will remain constant. So value of the firm, market value of the firm will be NPBIT upon KO. I got the market value. They have given me the market value, and total capital they have given me is 50 CR. And total market value of the debt, okay, market value of the debt will be how much? 10% debt to the extent of 30, 40 and 50. Okay. So now 10% debt. Okay. Out of the 50 CR, out of the 50 CR, 30% is going to be the value of debt here from total 50 CR. So 15 crores in option 1, then it is 40%. So it is going to be 20 and then 50%, so it's going to be 25 because total capital they have given it to me. Therefore, I know the value of debt, I know the value of the firm, okay, total value of the firm, okay, and I know the total value of the debt. So now I can find the market value of the equity, right? Market value of the equity will be what? A minus D, no? Market total value upon minus D. 66 minus 15. Then 66 minus 20. And then this 66 minus 25. Okay. Now interest rate is 10%. Okay. Interest debt 10% will be on how much? 15 lakhs. 10% on 20 crores. No, 15 crores, 20 crores and 25 crores. So now net profit available for equity shareholders will be what? A minus B. It is NPBIT minus interest. So 8 crore 50 lakhs, 8 crores and 7 crore 50 lakhs. So your KE will be net profit available for equity shareholders, which we just found out upon the market value of the equity here. So we have to see the market value of the equity and we have to see the net profit available for equity shareholders. Easy sum. Right, net profit available for equity shareholders upon the market value of the equity. Market value of equity we already found out. Right, we know the total market value of the firm. Okay, we know the value of the firm, we know the value of the debt. So balance will be the value of the equity. Interest rate is given, interest amount we can find out. Therefore, net profit available for equity shareholders we can find out. Right, so this is how it is. Okay. So capital structure, both your exam questions and all the important types of questions we have solved for capital structure. So this is it, what you have to do it in your, from your exam point of view. Okay. Okay. So now we are going to do one small important topic, okay, which is a part of this particular chapter. It is about economic value addition and market value addition, and there are certain questions which have been asked also in the past exam. It is a part of your module as well, and it is very simple. If this question is asked again, there can be no chance of any mistake. Now, understanding this word, okay, economic value addition. Basically, Economic value addition means what? That whether whatever the shareholders are giving to the company, okay, the amount of investment the shareholders have done, have the company done any value addition to that particular amount? Okay, so if basically I will say that the company is going to make profits, okay, company will make profit, all the profit after tax, okay, so net profit after tax, whatever is available, but that is not the only amount which is actually there, okay. From that profit there is another cost, which is what? Our cost of capital. So if the company has taken any loan, okay, a bank loan, debentures, any other type of capital, so whatever is the capital employed, on that there is a cost of capital involved. So profit is basically getting reduced with respect to this cost of capital. So say if a company is saying that yes, we are making a profit after tax of 10 lakhs rupees, but they have taken a loan of another say 10 lakh rupees, and in that they are paying some 12% is the cost of capital which is involved. So from 10, okay, if on say 100 lakhs, sorry, not on 10 lakhs, on 100 lakhs, on 100 lakhs they are paying 12%. So ideally they are paying 12 lakh rupees as a cost of capital. So this alone profit cannot be used to determine any addition to the value. So from 10, if I subtract 12, it is minus 2 lakhs. So in fact the value has eroded instead of increasing. There is no value addition happened in this case. So from the shareholder point of view, from the company point of view, it is important to ascertain whether the money which the shareholders are given for the business to grow, is any value addition happening in the business? Are we able to give some extra to the shareholders? So which type of profit are we interested in knowing? So the formula here first is EV is nothing but net operating profit minus, I just explained you, capital employed and cost of capital. In our case it was 12%, right? But which profit are we interested in? Net operating profit. Profit which is generated from your basic operations of the company. So say if you have sold a land and there is some profit made on sale of land, or you sold some other kind of a fixed asset which is not into your operations, so that type of profit should not be considered. So your net operating profit after tax, from there whatever is the cost occurred for your capital employed, if it is in positive, that means we have done value addition. Now capital employed, so like economic value added, if it is greater than 0, we have created value. If it is equal to 0, then value is not created, we are just recovering the cost. And if it is less than 0, then we have destroyed and eroded the value. Okay, so how do we find the capital employed? Basically, see, there is balance sheet, assets and liabilities. So we know that all that which is for long term in nature, long term capital, okay, long term capital is what we are talking about, capital employed. So here current liabilities is not included. So there are different ways of finding capital employed. Okay, so I can say that your entire total liability side minus your current liability will be your capital employed. So if I am taking the liability side approach, so I'll take the total of this liability minus the current liability will be my capital employed. Correct. Same thing if I am taking the asset side approach. So total of my asset side minus the current liability will be my capital employed. Correct. Or if I can even say that capital employed is asset side approach if I am saying fixed assets plus, okay, whatever are the current assets minus the current liabilities. So total assets is what? Fixed assets plus current assets minus current liabilities will give me my capital employed. So these are the different approaches to find the capital employed. Now current assets minus current liabilities, we know that it is working capital. So in the question, they might ask or give you this type of particular inputs for solving a sum. So you have to find out what is the capital employed, apply the cost on that, that will give you your actual cost of employed, and that we have to remove from the net operating profit after tax. Okay. So say example, XYZ Limited has the following financial information. Their NPBIT is 6 lakhs, tax rate is 40%. Equity share capital, reserves and preference share and debt. Weighted average cost of capital is 12%. We are supposed to find EVA. Okay, so NPBIT is 6 lakhs. So net operating profit after tax will be 6 lakhs minus 40%. Okay, 6 lakhs minus 40%, which is going to be 6 lakhs minus 40% is going to be 3,60,000. Capital employed, equity share capital plus reserves and surplus plus preference shares plus long term debt. So 5 lakhs plus 2 lakhs plus 1 lakh plus another 2 lakhs. So total capital employed will be 10 lakh rupees. Weighted average cost of capital is already given. So capital cost is how much? 12% on 10 lakhs, which is 1,20,000. My net operating profit is 3,60,000 and my cost on capital is 1,20,000. So obviously there is a positive EVA. Economic value addition is 2,40,000. Since EVA is greater than 0, it is generating higher than its cost of capital and creating value for the shareholders. Okay, this is the interpretation. You are supposed to write this interpretation. It will help you gain full marks. Okay. Same thing, second topic, market value addition. Simple. See, in my balance sheet, whatever capital I am showing, whether it is equity, whether it is debentures, preference shares, everything in the balance sheet is basically at book value. Okay, 10 rupees nominal value. Share capital face value 10, preference share capital face value 100, debentures face value 25, etc. Everything we show it at the book value, at the face value. But market has a different value of this particular securities. Okay, so in that, if I want to find out what is the market value addition, I will try to find the market value of the company and subtract that from the book value. So market value of the company will be market value of their equity, of their preference, of their debt. So for equity, number of shares into market price. For preference shares also market price into number of preference shares, and for debt also number of debentures into the market price of the debt. And book value is generally always given to us. Book value will be equity share capital plus preference share capital plus reserves and surplus. Now reserves and surplus does not have a market price. Okay, it does not actually have any market price. But in case of book value, it does have. So book value, if it is there, then reserves and surplus plus debt. So if your market value is more, MVA is more than 0, we have created wealth. If it is equal to 0, then we have just covered the investment, invested capital. And if it is less than 0, we have destroyed the investor's wealth. Okay. Let us kind of take one example. Okay. Let us first take the illustration and then we'll come to the conclusion again. Say equity share capital 10 rupees each means face value is rupees 5 lakhs. Reserve surplus 2 lakhs. Debentures is 3 lakhs. Number of equity shares is 50,000. Market price of the share is 20. Market value of this debt is the same as its book value. They are already telling us. We are supposed to find MVA. So first, what is the formula? MVA is nothing but the market value of the company minus the book value of the company. Market value means market value of equity. We have 50,000 shares. Market price is given 20 rupees. That is 10 lakhs. And market value of the debt, it is same as the book value. So I will take it 3 lakhs. So total market value is 13. But the book value of the company will comprise of equity share capital plus reserves and surplus plus the debt. Okay, so 5 lakhs plus 2 lakhs plus 3 lakhs, which is 10 lakhs. So market value addition will be 13 minus 10, 3 lakhs rupees. So what is the interpretation? Since it is positive, it has created wealth for the shareholders. So basically MVA shows whether we have the company's market value exceeds from the actual total capital invested, including all the forms of capital, more sources of capital, equity, preference, reserves, debt. Okay, so all that which is long-term shareholder value addition creation, it is known as market value addition, which is calculated. If it is positive, we have created wealth for the investors. Okay, so this type of questions when asked in the exam, obviously it is very simple. You have to just put in the formula, put in the figures which is already given in the question. Interpretation puts a star, okay, on your answer. So do not forget to solve the sums, write the interpretation and make your answer more like, give weightage to whatever you are writing in the exam. Okay, so ensure that you are writing properly all the notes, okay, to the question, or if you are making any working note, you are mentioning if there is, this particular amount is arrived with the help of this working note number 1 or 2, whatever it is. Maintain writing the given from the question so that you don't make mistakes over there. Apply the formula and then solve. Okay, all the best students. Thank you so much. See you all. Bye. Okay, so now we are going to dividend policy. Okay, now dividend policy, there are, there is formulas which you all need to remember, but trust me, I will explain you all how this formula is and you will be able to easily remember that formula. You don't have to do any mugging up. Just practice 1-2 sums again after you are done with this revision along with me. Okay, so now in case of dividend policy, here we are going to do 2 to 3 things. Okay, all right, in dividend policy there are 2 important concepts to understand. Okay, dividend, we all know what is dividend. Okay, when the company pays dividend on our capital, okay, the number of shares we hold. So there are 2 theories. One says that payment of dividend is relevant and one says that payment of dividend is irrelevant. Okay, the one which says that payment of dividend is relevant means what? Relevant to decide the price of the share in the market. Okay, so if dividend is paid or if dividend is not paid, it can affect the price of that share. That is what dividend relevance theory says, which is given by 2 people. One is Walter and one is Gordon. Okay, which they, if you will see, the formulas are different, but what they are trying to interpret and say it in the theory is the same thing. They are saying if there is a dividend, high, low, percentage or whatever dividend is being given, it definitely affects the price of the share. And then we have M&M approach, Modigliani Miller, which he says whether you give dividend, whether you do not give dividend, there is no effect on the price. Okay, so now these are the 2 approaches and models: dividend relevant model, dividend irrelevant model. Now coming to the dividend relevant model, we'll first do Walter's model. Okay, why Walter model? Because it is being propounded by James Walter. Now what does he says? Okay, that if you will follow the 3 rules which he has given, okay, then the share price will be maximum. Now what are those 3 rules? He is saying if your internal rate of return, whatever you are getting internally, okay, it is greater than the actual cost which is there in the market, which a company in the same industry prevails, and your return is higher in your company, you are able to generate better return, okay, as compared to the cost actually involved in that industry or in that same class of companies. In that case, you should retain more amount and give less dividend, least dividend. Take that money, deploy it for the growth of the business. But say if your return is less, then your K. R is less. Your internal rate of return is less than the actual which is prevailing there in the industry or in the market. Then in that case, give maximum dividend. Why? Because as it is, your rate of return is less. If you will not give dividend, shareholders will start moving out, right? So instead give them dividend and make them happy. And if R and K is same, then you can give any proportion of dividend. It will keep your share price maximum. Okay. So now how will you arrive at the price? How will you decide with the price? So there is a formula which he has said that price will be nothing. Okay. Price will be nothing but dividend plus return, internal rate of return, E minus D upon K, the whole thing upon KE, that KE only, where P is the market price of the share, D is the dividend per share, internal rate of return is R or return on equity is R, and outside capital, outside rate of return or return which is prevailing in the industry or cost of capital is K, and E is your earning per share. So say your earning per share is 10 rupees and from there you are giving a dividend of 10 rupees. So you are left with a balance of 5 rupees. Right. So this is what is the formula saying. So now based on the details, let's see whether what he is saying is the correct thing. He is saying, we'll just write it again. If you are getting greater rate of return internally, you should give the least dividend. And if you are getting less return as per the outside capital, you should give the maximum dividend. If we will follow this rule, then the price will be maximum of the share. Okay, so let's see, let us find out. They have given us 3 companies details, A, B and C, and R for A is 15, B is 5 and C is 10%, and cost of equity capital, okay, 10%, 10%, 10%. Earning per share again rupees 8. Same class of companies, industry is the same. Little bit changes are there here. Calculate the price when dividend payout ratio is 50%, 75% and 25%. Use Walter's model to determine the price. Okay, fine. So here, Walter's model. 3 companies are there, A, B, C. I have just written the given. For A, R is 15, K is 10 and earning per share is 8 rupees. B, R is 5, okay. K is 10 and earning per share is again 8. Here R is also 10, K is also 10 and earning per share is 8 rupees. Now in my first scenario, they are saying dividend payout ratio, They are saying dividend payout ratio is 50%. That means from your earning per share, 50% you are giving as dividend. That means 4 rupees will be dividend. What is the formula? D plus R into E minus D upon K, the whole thing upon K. So D is 4, R is 15%, E is 8 minus 4, dividend upon 10%, the whole thing upon 10%. Right? So 4 into 15% will be 6 rupees upon 10%. See. 6, 4 into 15% is 0.6. Okay, divide that by 10%. So that will become 6. So 4 plus 6 divided by 10%, rupees 100. You have to solve this. Or you can just convert this percentage into decimals. In my second, okay, R is changing. So 4 plus 5% of 4. Okay, 5% of 4 will be 0.2, divide that by 10%, it will become 2. So 4 plus 2 upon 10%, rupees 60. And then in the last case, it will be 10% again of 4. 4 plus 4 divided by 10%, rupees 80. Okay, that was my first dividend payout ratio. Next, dividend payout ratio is 75%. So out of 8 rupees into 75%, that means 6 rupees I am giving dividend. So in my formula, dividend will be 6 plus 15% of 8 minus 6 upon 10, the whole thing upon 10%. So here 2 into 15% divide by 10%. 2 into 15% divide by 10%. It is 3. So 6 plus 3 upon 10%, rupees 90. Here 2%, 2 rupees into 5% divide by 10%, you will get 1. 6 plus 1 upon 10%, rupees 70. and here 2 into 10%, 0.2 divide by 10%. Okay, that is going to be rupees 2. So 6 plus 2 upon 10%, 80 rupees. Now the last dividend payout ratio is 25%. That means out of 8 rupees, you are going to give only 25% of dividend. So only 2 rupees will be my dividend. So 2 rupees plus 15 into 8 minus 2, earning minus dividend. So it will be 6 into 15%, divide that by 10%, 9 rupees. 2 plus 9 upon 10%, 110. Here 6 into 5%, divide by 10%, 3. 2 plus 3, divide by 10%, 50 rupees. And last is 2 plus 10% of 6, divide by 10%. So 6 rupees. Right, this and this you can just cancel it if you want. Okay, so 2 plus 6 upon 10%, rupees 80. Now if you all have seen that in the last case where R and K both are same, whether you give any ratio of dividend, your price is not changing only. See, no, rupees 80 here when we 50% dividend, then 25% dividend also it is 75 also percent dividend 80 rupees, and 25% dividend also 80 rupees. Okay, but when here where R is greater than K and here R is less than K, no? Where R is greater than K, you see the least amount of dividend, 2 rupees. There the price is the highest, 110. Hence proved. And here R is less than K. R is less than K, then give maximum dividend, the price will be more. See, 70 rupees is maximum, 60, 70 and 50. Okay, so see, highest amount of dividend, price is maximum. Here least amount of dividend, price is maximum. And here any amount of dividend, price remains the same. Okay, so this is Walter's model, right? Now the same thing is told by Gordon also. Now what does Gordon say is, Gordon's growth model. He says that if R is more, your internal rate of return is more than the outside cost of capital, then you should retain maximum. Same thing, no? Give the least dividend, he said, no, Walter. He's saying retain maximum. If you are giving least dividend, you will retain only, no? More. If R is less than K, he's saying you should retain minimum. He's talking based on retainship, and there it was talking about giving of dividend. And if R and K is same, then anything you do, it will not affect the price. So here his formula is nothing but your earning per share 1 minus balance transferred to reserves, because he is talking about retaining. So from the earning 1 minus balance transferred to reserve upon whatever is the cost of equity outside minus balance transferred to reserve into the R, B into R, growth rate. Why? Because your this balance, if you will retain it and you will put it back in your company, it will give you growth, no, at the same rate of return. That is why it is known as Gordon's growth model. Okay, so now see, calculate market price of ABC Limited under Walter's model and under Gordon's model. I will show you for Gordon growth model. Earning, the dividend, cost of capital which is K, internal rate of return is R, and retention ratio, okay, B is 50%. Okay, everything is given. So now, okay, as per Gordon's model, K is 16, earning per share is 5. Okay, R is 20%, dividend per share is 3 rupees. Dividend payout ratio is 50%. How I came to know? Because balance retained is 50%. So dividend payout will be 50%. So price will be E 1 minus B upon KE minus B into R it is actually. Okay, so that you don't get confused. E we know, earning per share is given 5. We know the balance transferred to reserve is 0.5%. Balance 0.5. KE is given to me 0.16 minus balance transferred to reserve 50% into 20%. That means 0.5 into 0.2, 0.1. So 5 into 0.5 is 2.5. 0.6 minus 0.1 will be, 0.16 minus 0.1 will be 0.06. So 2.5 divided by 0.06. 2.5 divided by 0.06, you will get 41.67 rupees. Okay, price as per Gordon's model. Okay, price as per Walter's model, you can do it as a homework. Same thing you can apply. Okay, see here, Walter's model. D plus R, E minus D upon K, the whole thing upon K. E is given, R is 20%, earning per share is 5 minus again D upon K is 16%, the whole thing upon K is 16%. So 2 into 20%, 0.4 divide that by 16%, 2.5. So 3 plus 2.5 upon 16%, rupees 34.375. Both done. Okay, one more question we will solve. KE is 15, earning per share is 30, R is 14, 15, 16. You are required to calculate the market price as per Gordon's model, where B is balance transferred to reserves. 40 balance transferred, 60 balance transferred, 80. Fine. So I am just writing given R in one case 14, one case 15, one case 16. KE will remain the same, earning per share will remain the same. What is the formula? Price is 1 minus E into 1 minus B upon KE minus BR. Okay, now balance transfer to reserve. B is 40%. So 30 rupees earning per share, 1 minus 40% upon K is given 15% minus B is 40%, R is 14% given. Everything you can just put it into decimals. 30 minus 1.40, 1 minus 0.40 upon K is 15, B is 0.40 into 0.15. In this R is 1.5, no? And here it is, R is 1.6. So when you will solve, you will get the amount. Okay. Then when the balance transferred to reserve, retained earnings is 60%. Okay, so 60% means earning per share 1 minus balance transferred to reserve 0.6. Divide that by KE minus B into R. Here also B into R, 14, 15 and 16. Numerator though will remain the same only always. So here again you will get the price. Same thing, balance transfer to reserve 80%. So 0.8. So 0.15 minus 0.8 into 0.14, 0.8 into 0.15, 0.8 into 0.16. Numerator will remain the same, denominators will change. And here again the prices. So let's see. He is saying that when R and K are same, there is no difference, whatever you retain, how much you want. So let's see, when R and K is same, here both are equal. So is the price same? Yes, 200 rupees. Okay, 200 rupees. In third case also 200 rupees. Here R is less than K. So he is saying retain least. So least retain means 40% is the least, no? So see, price is maximum here. And when in R, you are getting better rate of return as compared to the outside capital, then retain the maximum. So maximum retainship is 80%. So there the price is the highest. See, 272 rupees as compared to 222, 209. Hence it is proved. Okay. Now Modigliani and Miller approach, where he says whether you pay dividend, you don't pay dividend, it does not affect the price. Okay, dividend is irrelevant to decide the price. According to him, the value of the company, whether dividend is declared, not declared, remain the same. Company's market value will be the same. To prove this, he has given this three equations. First is to find the price. We did this formula when we did the capital cost of capital thing. PO 1 plus KE minus D1 price. Then you have this another formula M. M is investment minus E minus N into D1 upon P1, and then you have this NPO which is N plus M into that price minus investment plus earning upon 1 plus K. Now what is all this? I'll explain with an example. Okay. Following is the details of ABC Limited. K is the capitalization rate, which is 10%. 1 lakh shares are there of rupees 100 each, existing. They are contemplating to declare a dividend of 6 per share at the end of the year. That is D1 is rupees 6. D1. Answer the following points. What will be the price, okay, at the end of the year if dividend is not declared, and what will be the price at the end of the year if dividend is declared? So based on his formula, we have to find the price. Okay, PO 1 plus KE minus D1. They have given us D1 already. They have given us KE also. Okay, 100 rupees is the price of the share. So currently it is 100 rupees. Now see this, I have already done this. So price of the share when dividend is declared, old price, capitalization rate, dividend. What is this? M. M is the new shares which is required to be issued. I is investments. Okay. E is the earnings. N is the existing number of shares. And D is the dividend. Okay. And NPO, value of the firm, existing number of shares into the price. Okay, NPO, existing number of shares into PO. M is the new shares, P1 is the new price, I is investment, E is earning, and K is capitalization rate. Okay, now as per the given, capitalization rate, dividend, N is number of existing shares is 1 lakh. Currently, PO is 100. Okay, earnings of the company, it is given rupees 10 lakhs, and they make a new investment of 20 lakhs. How many new shares must be issued? Okay, earnings is 10 lakhs. Okay, and investment they need is of 20 lakhs, new investment. So when dividend is declared, the price P1 will be PO into 1 plus K minus D1. Dividend is declared, PO is given, KE is given, D1 is given. You have to just put it in the formula and solve. So 110 minus 604 rupees per share when dividend is declared. When dividend is declared, new number of shares that is required to be issued. Okay, new number of shares that is required to be issued is M. M is equal to investment minus earnings into N minus D, N into D1 upon P1. Why? Because whatever investments I need, this 20 lakhs. Okay. This 20 lakhs, this is the amount of investment I need, and I have some earnings, but that earnings is going to get reduced due to dividend. The number of shares, 1 lakh shares, I gave them 6 rupees dividend, I had 10 lakhs rupees earning. Okay, so for that 20 lakhs of investments which I need, okay, how will I calculate the actual number of shares? By the investments minus whatever is available with me. Okay, so investment is 20 lakhs. What is available with me? My profit. But from that profit, I am giving dividend. So that will be balance profit will only be available. Now from 10 lakhs, 6 lakhs I gave dividend. So now I am available only 4 lakhs of profit. So for the 20 lakh investment minus 4 lakhs, I can use as my internal amount available to me. So 16 lakhs I'll need from outside. What is the price of the share right now? I calculated 104. So how many new shares I'll have to issue? 15,385 new shares. Okay, so now the value of the firm, NPO, market value of the firm, will be N plus M, old shares plus new shares into now, what is the market price now? Investments plus earnings, divide that by N plus KE. Okay, you have to just put this in the formula. So it is going to be NPO, market value of the firm, will now be 100 lakhs rupees. Now say when dividend is not declared, I'll first find the price. Price will be PO, 1 plus K minus D1. So 100, 1 plus 10%, D1, 0, dividend not declared, not paid. So 100 into 0.10, 110 rupees per share. Right? So now new shares required to be issued will be M. Investments which I need minus whatever I am available with. So earnings is 10 lakhs minus existing number of shares into D1. Now existing number of shares are 1 lakh, but dividend I gave 0. So I'm left with my full earnings. So 20 lakhs minus 10 lakhs. 10 lakhs divided by 110. So 9,091 new shares I need to issue. New shares. So value of the firm will be old shares plus new shares into the current price when dividend is not declared, 110 rupees, minus investments which I need plus profit which I have, upon 1 plus the cost of equity. So it is going to be 12 lakhs minus 10 lakhs upon 1.10. Again it is going to be approximately 100 lakhs. So hence it is proved whether dividend declared, not declared, because of the new investments which you keep doing, you will need more shares, and because of that your automatically market value of the firm is going to remain the same. Okay, so now that was with your some types of question. Now past exam questions for dividend policy. ABC Limited has provided the following information: earning per share, dividend and cost of capital K. R is 16. You compute the market price using Gordon's formula and Walter's formula. Very easy. Chalo. Everything is given: D1, earning per share, KE and IRR. Gordon's model, P price will be earning 1 minus B, KE minus B and R. Okay. Now tell me one thing. If you are giving dividend of 9 rupees upon 25, 9 rupees on 25 per share, earning per share, what is the dividend payout ratio? 36%. Therefore, balance transferred to reserve will be 64%. Na? Then only it can make 100% of earning per share. Right, out of 25 rupees, when you are giving 9 rupees as dividend, so balance you are transferring it to reserves, right? So earning per share is 25. 1 minus 0.64. K is given, 0.64 into internal rate of return is also given, this is R. So 9 upon 0.12 minus 0.1024, price is 511.36. As per Walter, D plus R into E minus D upon K, the whole thing upon D. E is there, K is there, everything is there, R is there. You have to just put it in the formula and solve it. 252.78. Okay, question number 2. RST Limited has a capital of rupees 10 lakh in equity shares of 100 each. Okay, so basically you have 10 lakhs. So 10,000 shares you have existing. The shares are currently quoted at par, 100 rupees. Market price is also 100. The company proposes to declare dividend of rupees 10 per share at the end of the current financial year. Capitalization rate means KE. Okay, KE is equal to 12%. You are supposed to find the market price of the share at the end of the year when dividend is not declared and dividend is declared. Okay, price when dividend is not declared: P1, PO 1 plus KE minus D. PO is given, KE is given, dividend not declared 0, so 112. Price when dividend is declared, D1 is how much? 10 rupees. So just 112 minus 10, 102. Okay. Assuming the company pays the dividend and has a net profit of 5 lakhs and wants to make a new investment of 10 lakhs. So IE is 10 lakhs. Okay, earnings is 5 lakhs. Okay, company is paying the dividend. How many new shares need to be issued? So new shares is, what is new shares? M is equal to I minus earnings minus old shares and dividend paid. So 10 lakhs I require as investment, but what I have the earnings, from that earnings my dividend paid will get reduced. So from 5 lakhs, 10,000 shares into 10 rupees, 1 lakh. So from 5 lakhs, 4 lakhs, 1 lakh is going as dividend. So 4 lakhs will remain. So 6 lakhs divided by 102, because price when dividend declared become 102. So how many new shares? 5,883 shares approximately needs to be issued. It's a 5-mark sum. Okay, so with this we have completed our dividend policy also. Okay, so just go ahead, revise all this, solve 1-2 example questions here and there. All the notes, everything is available. You have to just go through it, resolve it, and you are ready for your good, 40 marks of your FM. Along with in theory, you all can just read it. It is all based on what we have solved. Now it is going to become very simple for all of you. Okay. Hi everyone, welcome back to our another marathon session for a financial management paper. Okay, this marathon again is going to be very useful from your exam point of view, for scoring good marks and for getting in fact exemption marks if you just follow what I am going to teach you over here. Okay, so just pay attention. You do not have to rush ahead and go and write and solve something while I am teaching. I am giving you my solved notes. You can take this solved notes from the link. It is given in the description. Take a printout or solve it from there, and from there you can later on solve it by yourself in your book. Okay, so don't waste your time while seeing the lecture. Just pay attention as to what I am doing in that particular chapter. All the important chapters from exam point of view which have really weightage of good marks, I have taken all that in the marathon. Previous marathon I had done 4 chapters with you all. Now today we are going to do capital budgeting and security analysis. Okay, now capital budgeting, generally I get a lot of messages from students, so it is very difficult, we cannot understand. I tell you, this is the most easiest chapter of financial management. It has just a lengthy way of solving the sums, but I feel that it is the most simplest chapter of the entire FM portion. And you will come to know why. I'm going to tell you why it is simple. Because it has the monotonous way of solving all the sums. If you know a particular type, that sum cannot change. It will come in that same manner. There is nothing new which can happen in capital budgeting. Okay, so I'm going to solve a few questions, a few types, okay, which are the maximum thing which can be asked in exams, and we will solve the past exam questions also over here. Okay, theory, I have given a few theory, you can read it from here. Capital budgeting is more on the practical side. Okay, so we will focus on solving of the sums. Good, sometimes capital budgeting is asked for good 10 marks. Sometimes it is for 7 to 8 marks, but it is an important chapter. We are going to solve it. Okay. Now, what is capital budgeting? It is basically again a management related aspect. Budget. Okay, we know what is a budget. If I want to buy something tomorrow in the market, I want to buy a particular, a purse or something. Okay, I have a budget which is set up. I will have to understand whether buying of that product is going to be beneficial for me. Whether should I go for product A or for product B. Okay, how it is going to benefit me. So here, when the management of a company, we think from the company point of view. FM and accounts, we always think from the company point of view. Become a company and then read the question. Okay. So for a company, if they are investing their money, a huge amount of money, say on a machinery or on investing in a plant or taking up a land and a building, okay, some type of a capital asset. So they can just not, like, it's not a decision which is taken today and tomorrow things will turn up. Okay, it is a big decision. Okay, it is a decision which is going to involve a huge amount of money, and that money will help you generate profits over the period. Correct? So capital budgeting, understand one thing, it is about capital assets. And the object of the company will always be to minimize the cost and maximize the profit. So if in basic term I tell you that your asset value, okay, is going to be 20,000. Okay, and it is going to, this asset is going to have a life of 5 years. And in that 5 years, it is going to give you a profit of, say, 10,000 every year. So 10,000 profit every year, that means you are going to make 50,000 in 5 years. And your cost is only 20,000. Obviously, you will say, ma'am, we are going to go ahead with this particular asset. But if this would have been other way round, if I would have told you that the asset is 70,000 but it is going to give an income of only 50 over 5 years. So then it will be like cost is much higher than our income. We will kind of not accept this particular asset or the project, right? So in capital budgeting, we are going to understand what is the outflow of the asset. That means what is the money which we need to invest and what is the inflow of the asset, and based on that we will take a decision. Okay, so why do we need capital investment and importance of capital budgeting? All this you can do it from the theory point of view. Okay, whether to accept and reject the projects, mutually exclusive decisions, capital rationing decisions, all this is important. Okay, now I will first come up with a example. Okay, first we will just start with one example sum. Okay, reading of the question, then we'll go back to the theory. Now say there is a machine. Suppose a machine is costing rupees 50,000. Okay, like my example, and it is expected to provide cash inflow at the end of the year. There are 3 years. For 3 years it is going to give me inflows. The life of the machine will be 3 years or something, and each year 30,000 of inflow it is going to give me each year. Inflow, cash outflow. We are interested about inflow and outflow in capital budgeting, okay, of that particular capital asset. Okay, should we accept the project? Okay, we will read the sum only till here right now. Should we accept the project? Okay, PV factor 10% and all that, I will come to it. I'll explain it to you later. But right now we are going to only focus on this particular matter as an example. I want to give you an example of making this particular decision, whether to accept the project or not. Okay, so say machine has costed me 50,000 rupees, right? Now you see, these are my solved notes. If you all have attended my previous marathons also, everything is given it in my notes. First method, there are 2 to 3 methods which we will kind of look at and see whether we can go ahead with this machine or no, buying of this machine. First is your inflow and outflow. Simple. Inflow minus outflow. Your inflow has to be more than your outflow. You have to have some net profit in that. So inflow to they have given me, it is 30,000 for 3 years. So basically 30,000 into 3, and outflow is 50. 90,000 I am going to get money with this machine. 50,000 is the cost, 40,000 is my net profit. Yes, I will accept the project. Why? Because NP is the positive. Here I have written. Simple. Next is your payback period. More than the net profit, sometimes the management wants to see when do we reach the break even. This 50,000 which we have invested, in how many years are we going to get that back? The capital invested is capital gained again. Okay, inflow has already taken place. In how many years is this going to happen? Inflow is okay every year, but how much time will I take to break even? That is also what I want to know as a company's management decision maker. So payback period. So there are 3 years. Inflow is given. I will just do cumulative. In first year I will have 30 recovered. In my second year it will be 30 plus 30, 60 recovered. And then in my last year it will be 30 plus 60, 90 recovered. Cumulative. Correct? 90 will be recovered in the third year. In the first year 30. In second year total is recovered is 60. In the last year total recovered will be 90, total cumulative. My initial investment is 50,000. Right? In the first year itself, I am receiving 30. So balance now 20,000 is only left. Right? Now in the first year itself, I have received 30. So balance left is only 20. Now I am taking 12 months to earn this 30,000. So 20,000 I will earn in how many months? 8 months. Cross multiply 20,000 into 12 divided by 30,000. So my payback period will be 1 year, so I take only year. Plus my 8 months. So 1 year and 8 months will be my payback period. Okay. So now if this payback period is acceptable and stated by the management that yes, 1 year 8 months it's good to have the break even achieved, yes, then we will accept the project. Okay. And the last one is benefit and cost ratio. Same thing, inflow upon outflow. First we did inflow minus outflow for net profit. Here we'll do inflow upon outflow. Inflow total is 90, outflow is 50. My benefit cost ratio is 1.8 times. Okay, so if the benefit cost ratio is greater than 1, this is the standard. Okay, if it is greater than 1, you can accept the project. Okay, that means your benefit is more than your outflow. Benefit is more than your cost, then you can accept the project. Simple, easy, all the three methods. But here we are not factoring the time. Okay, it is not necessary, no, that, see, you are saying that 30,000 I will receive after, at the end of the year. Okay, at the end of the year I will receive 30,000. So this 30,000, what is the present value? How much is the present value of this 30,000? I will receive it at the end of the third year and end of second year, end of the first year. At that time it will be 30, na? What is its present value? So I will tell you something. If I want to earn this 1 rupee at the end of the first year, how much I will have to invest today at a given rate of interest is what is known as the present value. In order to earn that 30,000 at the end of the year, what is my present value at a discounted factor? This is known as a discounted factor, interest. Because this particular money is going to grow at that interest and going to become 1 rupee. Time and interest has to be taken into account. Okay. That is why net present value method is important. In this method, your inflow and outflow will be bought to their present values. Now, outflow will be present only. Why? Because it is right now you are spending that money. So, it will be the present value. So, outflow is not a problem. But inflow is at the end of certain years. So, what is the present value today? Based on that, you will be able to take the decision. So, any inflows which are given, you have to discount it with the interest factor. Whatever interest rate they have given. If they have given 10%, 11%, 12%, which is running in the market in order to take this capital asset decisions. Okay, capital budgeting decisions. Right. So, in our case, they are saying that the PV factor, present value factor is 10%. Now, whenever any rate is given, you will do 1 divided by that rate. 1 plus 10% will be 1.10. 1 plus 10% will be how much? 1.10. You will do this always. So, say if it was 15%, you will do 1 upon 1.15. Right? 1 plus that 10%. So, if I am doing 1 plus 10%, it will be 1.1. 1 plus 15%, 1.15. Okay. So, whatever is the PV factor, okay, in order to get that discounted factor amount, that means what? In our, see, this example means that if you will invest 0.9091 at the rate of 10%, okay, for a period of 1 year, you will get 1 rupee. See, do it. Take your calci. Do 0.9091 plus 10%. You will get 1 rupee. See this. Approximately 1 rupee. For 1 year. Okay. So, now how do I get these figures? You will just do 1 divided by 1.10 equal to sign. 1 divided by 1.10 equal to sign, you will get 9091 approximately. Again press equal to sign, you will get it for the second year. 0.8264. Again press equal to sign and you will get it for the third year. 0.75. See, I have made 3 equal to signs. Why? Because there are 3 years, no? So 1 divided by 1.10 equal to, you will get this first answer. Again press equal to, you will get this second answer. Again press this equal to, you will get the third PV factor amount, value. Okay. So now you will multiply this 30,000 with each PV factor value, present value. Okay, each PV factor amount, and then with the help of that you will get the present value. So you see 30,000 at the end of 1 year. Today its value is only 27,273. 30,000 after 2 years, present value today it is only 24,792. And present value of 30,000 at the end of the 3rd year, today its value is only 22,539. Correct? Okay. So this is how you are going to solve it. Even generally sometimes in the exams they give you this PV factor value. But even if they have not given, it is not easy. Whatever is the percentage, you will do 1, divide that 1 plus that percent. So 1 plus 10% in our case, that is why I have done 1 divide by 1.10. Correct? So now you will multiply and now you will get the PV inflow total. You will compare this inflow with the help of the outflow. This is going to be your net profit. Here again net profit is positive. We will accept the project. Clear? Same thing. Now we will do the discounted payback period. We did a payback period. Now we will do discounted payback period. We will write the years and we will write the PV inflow. And we will not write a normal 30,000 inflow. We will write PV inflow and do the cumulative, same thing. So first year I will recover 27,000. Second year I will recover 27 plus 24, 52,065. And then in the third year 52 plus 22, 74,604. My initial investment is 50. In the first year I have already earned 27,273. Balance left in the second year is, balance I can achieve it in the second year easily. Okay, 22,727. I am earning 24. See here, I am earning this 24,792 in the second year. That means I am earning this over a period of 12 months. So in order to earn 22,727, how much months I will require? I will cross multiply. So when you will do a cross multiplication, you will get 11 months as an answer. Therefore, payback period, discounted payback period will be 1 year plus 11 months. Okay, payback period means achieving the break even. Okay. Profitability index, instead of benefit cost ratio, we will term it as profitability index when we do PV factor. Profitability index is PV inflow upon PV outflow. The formula remains the same. 1.493 times it is greater than 1. Profitability index is good, higher the better, greater than 1. Therefore, we will accept the project. Accept the project. Okay. Simple, easy. We have to keep doing this only. 1.49 approximately 1.5 times. Right. Now let us do a similar sum. But a little bit of twist here and there is around this. A company gives you the following data. There is a plant and machinery which is going to cost 10 lakhs, and then there will be working capital also required in order to work this plant and machinery. So whenever they give you working capital, your outflow will be the cost of that machine plus the working capital. Always remember, working capital, assets minus liabilities, your basic working capital in order to get this machine into working. Okay, so your current outflow will always be these two things. Okay, outflow will always include working capital. So 10 lakhs of machine plus 2 lakhs of working capital, my outflow will be 12 lakhs. Working capital, whatever we invest, is always recovered completely. Okay, that is what we assume in budgeting, because working capital is an operating cycle. Every year you keep on recovering it. Correct? So 2 lakhs, whichever is invested, at the end of the life of the asset, you will recover it entirely 2 lakhs. So that is not a problem. Okay, so right now, though your outflow is of 2 lakhs extra, you will also receive 2 lakhs at the end of the life of the asset. Okay, so 2 lakhs working capital. We have depreciation, 20% on straight line method. Salvage means at the end of the life, you are selling this, the value of this machine will become 3 lakhs. Tax is 20%, selling price 100, variable cost 50 and fixed cost is 20,000. 4 years are given and the quantity of the products is given. We have to calculate the net present value and its viability, assuming interest rate at 10%. Interest rate means PV factor is 10%. If it is 10, then 1 divided by 1.10. Okay. Now they have given me quantity, they have given me selling price, variable cost and fixed cost. With that, I can find out my cash flow before tax. They have given me the tax rate also, but at least cash flow before tax I will be able to find out with the help of all this information. So outflow is 10 lakhs plus 2 lakhs, I told you 12 lakhs. Cash flow before tax, we will have to first find CFBT. What is your CFBT? All your total sales minus all your expenses, you will get your cash flow before tax, and then from there you minus tax later on. Correct? We do know the income statement, sales minus variable cost minus fixed cost, you get profit before tax minus tax, profit after tax, that is it. Okay, so let's see. I've written everything here in the table. 4 years only we have to do. Quantity they have already given me 5,000, we are selling 8,000, 10,000, 12,000. Selling price is 100 rupees. So my sales value will become here 5 lakhs, 8 lakhs, 10 lakhs and 12 lakhs. Variable cost is 50 rupees. So 50 into 5,000, 2 lakh 50, 50 into 8,000, 4 lakhs, 50 into 10,000, 5 lakhs and 50 into 12,000, 6 lakhs. Selling price, variable cost also I have, fixed cost is also given 20,000. So from selling price, I'll subtract variable cost, I'll subtract my fixed cost, I'll get my CFBT. 5 lakh minus 2 lakh 50 minus 20, 2 lakh 30. Right? From this 8 lakhs minus 4 lakhs minus 2 lakhs, I'll get 3 lakh 80. 10 lakhs minus 5 lakhs minus 20,000, 4 lakh 80. 12 lakhs minus 6 lakhs minus 20,000, 5 lakh 80,000. Okay. Alright. Now. Okay. Now, depreciation is the catch over here. Okay. My cost of plant and machinery, they have told me is rupees 10 lakhs and 20% on straight line method, means every year same amount of depreciation is being given on the asset. Okay, so 2 lakhs per annum will be my depreciation cost. Correct? 2 lakhs will be my depreciation cost. Now what happens is when there is something like this, okay, there is this depreciation and all that. Okay, we know our income statement, sales minus variable cost minus fixed cost will give me my net profit before tax. Correct? From there, say depreciation, which is a non-cash expense. Okay, I remove that. Again, net profit before tax. Here I will get minus then tax. Now, because of this depreciation, which is a non-cash expense, okay, my tax reduces. Why? Because this has reduced. Okay, so my tax amount will reduce. So say sales is 100, variable cost is 30, say fixed cost is 20. So NPBT year before depreciation is 50. Then depreciation is again 20. So my NPBT becomes 30 and tax rate, say it is at the rate of 10%. For example, so this will become 3 and then I'll get net profit after tax as 27. Because of this depreciation, my NPBT has reduced. Because of that, my tax rate has also reduced. Only 3 rupees tax I'm paying. Right? Though this is a non-cash expense. So whenever there is a depreciation, my CFBT has to be adjusted. See. Now how will I adjust? I found out my CFBT from here. All the 4 years. I'll just write it over here. CFBT. Year 1, 2, 3, 4. CFBT 2,30,000, 3,80,000, 4,80,000, 5,80,000. Depreciation I just showed you all. Every year we are taking 2 lakhs of depreciation. So I will just write the depreciation. With the help of CFBT and with the help of depreciation, we have to find out cash flow after tax. Now for every year, if I'll keep making this income statement, it will become very difficult for me. I can make it. I will say CFBT, then depreciation I will minus, and then whatever is left on that I will minus tax. Tax rate they have already given me, na? Tax rate is 20%. It is already given to me. I can do income statement for each year. But if you need a shortcut for this, what I'll do is, my tax rate is 20%. So near depreciation, I'll write 20%. And balance, I will write at 80% of CFBT. So now what I will do is, depreciation amount of 2 lakhs, I'll take only 20% of 2 lakhs. Okay, 2 lakhs into 20%, that is 40,000 each year I will take from that depreciation amount. I will add that 40,000 to the 80% of my CFBT amount. So 80% of 2,30,000, if you will do it on your calci, you will get 1,84,000 plus 40,000, that is 20% of the depreciation amount, 2,24,000. That will be my CFAT. This income statement which I just did, it is that only. So in order to arrive at this for every year, you will have to do this income statement. Because to the extent of the tax rate, okay, I am saving it. I am saving this tax rate on this depreciation. Because I could minus this depreciation, 20% of my tax rate is saved, na? So I'll take 20% of depreciation and I'll take 80% of my CFBT. Right? So I will get this amount directly. So here you will take 80% of 3,80,000 plus 20% of 2 lakhs, which is 40,000. If you want, you can directly write here 40,000 also. But for your explanation, for your understanding, I am doing this. Then that will become 3,44,000. 80% of 4,80,000 plus 20% of 2 lakh will give you 4,24,000. And then 80% of 5,80,000 plus 20% of 2 lakh will give you 5,04,000. Now discounted factor rate 1 divided by 1.10. Do equal to 1 divided by 1.10. Okay, equal to 9091. For second year again equal to 8264, 7531 and 6830. Barabar? Only till year, okay? Only till year. We are doing it till year. Till the 4th year. Just multiply the CFAT with the discounted factor to get the present value of the inflow. Okay. Now in the last year, 2 events will take place. I told you whatever is your working capital invested will be your working capital recovered. So working capital invested was 2 lakhs. So I'll recover also 2 lakhs as my inflow. What is my 4th year's discounted factor rate? You just found out 0.6830. So I'm going to have the present value of 1,36,600. This also I will take into account. Next is my sale of my asset. Okay. See. Cost of my plant was 10 lakhs. I gave depreciation for 4 years, 2 lakhs per year. So depreciation was 8 lakhs. 2 lakhs into 4. 8 lakhs. So my written down value now remaining is 2 lakhs. But what happened is I sold this machinery for 3 lakhs rupees. right? So I had a profit of 1 lakh. This profit is going to get taxed at 20%. How much tax? 20,000. So what will be my actual inflow? I will not receive full 3 lakhs. No, 3 lakhs I will receive it as a salvage value. Inflow, cash inflow. I am not only concerned with the profit. What is my cash inflow at the end of the 4th year? Because of selling of this plant, I am going to receive cash of 3 lakhs rupees. But I will also have to pay the income tax 20,000. So actual sale of this plant and machinery will give me only 2,80,000 as a cash inflow. Amount actually received in cash. 2,80,000. So this 2,80,000 also I will discount it with the help of the discounted factor for the 4th year. I'll get the present value today. So I'll add them all. Total 14,78,542. That I will compare it. Okay. I will compare this inflow minus outflow. See, NPV. Inflow is total this. Outflow is 12 lakhs. Your net present value, your net profit is, we have to find this. Net present value is positive. Therefore, we will accept the project. Okay, so this is going to be the maximum thing which can be asked in the exam regarding capital budgeting. Okay. Now, there is one thing like of a different type of a sum. Okay, different type of sum. Now, I will take you all to the theory also again. See this. There is an outflow of 3,50,000. 4 years is the life, and CF80. Per annum, we are going to get 1 lakh, not different. Every year 1 lakh. PV factor 8%, external rate of return. This is, they are telling me calculate the internal rate of return. Now this PV factor, we are calculating and getting it based on what is happening in the industry outside. So we are taking that much. But our internal rate R can be different than the cost which is prevailing outside. So they are telling us find the internal rate of return. Internal rate of return is that rate at which your net profit is equal to 0. Means your outflow and inflow is becoming the same. Which net profit? Net present value profit is 0. Then you can say that this is your internal rate of return. External rate of return PV factor 8% is given, but they are asking what is your rate of return actually internally. Okay, so now see this. PV outflow given 3,50,000. Okay, PV factor is given 1.8%. That means what? 1 divided by 1 plus 8%. So you will get 1 upon 1.08. There are 4 years and CF80 for all the 4 years is 1 lakh. So instead of doing 1 divided by 1.08 into, for 4 times, directly do a cumulative PV factor, no? Because 1 lakh only you have to multiply, so do directly cumulative total. So you will get the PV inflow because it is 1 lakh for all the 4 years. So for all the 4 years, do a cumulative 1 at the end of the 4th year. You will get your PV inflow over here. So now how to do that? I will show you. On your calci, pay attention. Okay, first clear your calci. Okay, there should not be any M or anything on this side. Okay, clear it by doing MRC and clear it. Clean the memory. Okay. Now 1 divided by 1.08. You will do equal to 4 times and then keep multiplying that by 1 lakh. You can do it. No problem. But I am showing you this one more method. You can do like this. Equal to M plus 1. Equal to M plus 2nd year. Equal to M plus 3rd year. Equal to M plus 4th year. And press MRC. You will get this memory of 3.3121. Okay. What you will do is 1 divided by 1.02 equal to M plus again equal to M plus, again equal to M plus, again equal to M plus. Why? Because fourth year. And then press MRC. You will get this PV factor cumulated for 4 years. Multiply that by 1 lakh. You will get your PV inflow. PV inflow minus PV outflow. Oh my god, negative 18,790 loss. Okay. Now internal rate of return is that at which NPV has to be 0, not negative. So what I will do is, since I am getting negative, I will reduce the PV factor. No, this is coming negative. Why? Because the discount factor rate is 8%. That is why. Now reduce it. So you take it 2% at a time, 6%. Now do it with the help of 6%. Maximum 2% can be taken. Obtain one positive NPV and one negative NPV, and we will be able to solve this sum easily. Okay, so at PV factor 6%, everything same, 1, 2, 3, 4, CF80 same. Now I'll do 1 divided by 1.06 equal to M plus, equal to M plus, equal to M plus, equal to M plus, and then press MRC. I will get this PV factor. Let's see, let's try. Clear the memory. Okay, do 1 divided by 1.06 equal to M plus 1, equal to M plus second time, equal to M plus third time, equal to M plus fourth time, MRC. 3.4621, 4651. Okay, so my PV inflow is 34,6510. Again I got negative NPV. Inflow minus outflow. So I need one negative and one positive. No, so now again I'll have to do it. 3490 is my loss. So again 2% down I am trying to go. So 1, 2, 3, 4. 1 lakh rupees is the CF80 for all the 4 years. This will be 1 divided by 1.04 equal to M plus, equal to M plus, equal to M plus, equal to M plus, and then press MRC. You will get this cumulative factor, multiply, you will get your PV inflow. Now you will get a positive one. 362990 minus 3,50,000, it is positive 12,990. Now we will be able to find the answer. Now what happened is, PV factor from 6% I went to 4%, right? 2% I went down. In that what happened, I made a profit or amount of actually 16,480. I could write off the previous loss and I am left with a profit of 12,990. So actually how much money I made? 16,480. Because see, if I am making 12,990 positive, that means I was able to write off this also, na? From 3490 minus 3490, I'll have to first reach till 0 and then I'll be able to reach till that particular 12,000 something, no? So 12,990. So loss plus 12,990, I was able to make an inflow of 16,480. Okay, but I want to make an inflow positive of 3490, one negative 3490, one positive 3490, then it will become 0, no? Minus and plus, it will become 0. So cross multiply 2490 into 2 divided by 16,480, 0.423. So you will have to just go down by 423 from 6%. So 6 minus 0.423 at 5.577. This is the exact internal rate of return where your NPV will be 0. I am explaining once again. Internal rate of return is that return where NPV is 0. With the help of the external rate of return, we could find that there is a loss of 18,790. So what we did is we reduced that and we said let's try it with 6%. When we tried with 6%, we again got a loss of 3490. Okay, we want this to become 0. Minus 3490 to reach to 0 has to become plus 3490. Only then it will reach to 0. So I went 2% more down. I said let's try with 4%. Okay, when we went to 4%, there was a profit of 12,990. That means this profit was left, why even after absorbing this 3490 na negative. So 3490 plus 12990, I made an inflow of 16480. So when I went 2% down, my inflow became 6480. But I want an inflow of only 490, positive 490. So how much down I'll have to go? Cross multiply. I get 0.423. So 6% minus 6 minus 0.423, 5.577% will be my that rate of return where my NPV will be equal to 0. Okay, everybody? Alright. So now I am going back to my theory a little bit over here. Okay. Net present value and internal rate of return approach. Okay, net present value, internal rate of approach are the two used methods. Okay, discounted cash flow method. Okay. So there are certain differences. Interest rate under net present value method, rate of interest is assumed. Okay, whereas in as a known factor, whereas it is unknown in case of IRR return method. We don't know the IRR. Reinvestment axiom, under both the methods, it is assumed that cash inflows will be reinvested at a discounted rate for the new projects. An objective is the net present value method to ascertain the amount which will be invested in the project so that expected yields will exactly match to the repay of the amount. That is why we are doing, no? In order to earn that 1 rupee today, what will be the value? Okay, then we have some points of similarities. So you can just read that. It is not going to be asked, but you can read it. If in case you know this concept, you will be able to attempt an answer. Okay, now I am doing a full comprehensive sum in which everything is there. Okay, everything we have to do. We have to do net present value, we have to do payback period, we have to do discounted payback period, profitability index, IRR, everything is there, see, in this sum. Okay, so everything together, one revision sum. Then we will go to the past exam questions. See, now X Limited is planning a capital expenditure of 5 lakhs. This project will require working capital of 1 lakh. So by now you all know, any project working capital has to be added to the cost. Depreciation on this capital expenditure is to be provided in such a way that the capital cost is written down to 50,000 at the end of 5 years. Means the written down value at the end of 5 years has to be 50. Which is also its market value at the end of the year. Salvage value. When you will sell it, you will get 50. Okay. The new project will require use of existing premises which is currently rented out for 1,000 per month. That means you will use this premises also. Yearly, how much rent you were getting? 12,000. Now you will not get that rent. Now you will not get, because you will be using this premises. Okay. So like kind of it is now going to become like an expense for you instead of an income. Expected revenues of the project are given for the 5 years. The company's cost of capital is 12%. That means your PV factor is 12% and tax rate is 40%. We have to find the net present value first. Okay, so let's go to the problem. 5 lakhs plus 1 lakh is my PV outflow, 6 lakhs rupees. First thing I did depreciation. 5 lakhs is the cost minus WDV upon number of years. How many years? 5 years. 5 lakhs minus 50,000 divided by 5. 90,000 is going to be my depreciation every year for this 5 years. How much tax benefit I will get on that depreciation? Remember we did that table, 20% of the depreciation amount you will take. Tax rate is 40%. So I will get that much of benefit on depreciation. So 40% of 90,000 is going to be 36,000. Now this 36,000 directly I can write in my table today. Okay, so I have done it in this method also, in this way also. It's not a method, it is just way of solving. So first I need to find my cash flow before tax. They have given me the years, they have given me the revenue. Okay, now from that revenue I'll have to minus this rent. Why? Because now I'm not going to get it. It is as good as a notional expense. Now you will have to kind of, when it's not an income, it becomes your expense. You are not going to get this 12,000 anymore. So my CFBT will be 3 lakh 3, 1 lakh 70, 1 lakh 24, 1 lakh 73, 1 lakh 80. All this is given. Revenue was given, rent is also given. So my CFBT is easy to find. Right? Now with the help of my CFBT, I can find my CFAT. So all the 5 years, CFBT, I will just write it down as we have found out. Depreciation. Okay, the benefit, tax benefit on depreciation, I am going to write it. In the last sum, I had written the depreciation amount. Correct, 2 lakhs, and then we were taking 20% of that 2 lakhs. Sorry, yes, 2 lakhs. 20% of that 2 lakhs I was taking at that time. Now I have already found out what is the tax benefit on depreciation. Depreciation is 90,000. Tax benefit of 40% is going to be 36,000 every year. So I am writing that 36 here. So take 60% of 3,03,000 and add 36,000 to get your CFAT. So 3,03,000 into 60%, 1,81,800 plus 36,000, 2,17,800. Similarly, take 60% of 1,70,000 and add 36. You will get 1,38,000. Right? Next, you will take 60% of 1,24,000, add 36, 60% of 1,73,000, add 36, 60% of 1,80,000, add 36,000. You will get your CFAT. CFAT has to be discounted at the PV factor 1 divided by 1.12 equal to sign. Let's see. 1 divided by 1.12 equal to 0.829 equal to 7972 equal to 7118 again equal to 0.6355 and last again equal to 0.5674. So my CFAT is going to change. Present value I have to multiply equal to, okay, you all can solve this again later. It's good, it's a good sum. It is like a comprehensive sum, everything in one. Working capital invested will be working capital received again at the end of the 5th year. So I'll take the 5th year's PV factor. And there is a sale of assets, salvage value 50,000. They have told me already. Again that I will take it at the end of the 5th year's PV factor. And now I will get a total of 6,83,730 minus outflow. My NPV is 68,730. A is solved. A. See, sale of the asset I have done. See. Cost 5 lakhs. Depreciation for 5 years 4,50,000. WDV is 50. Minus sale also 50. There is no profit, that tax rate or anything is going to come here like previous sum. So 50,000 I received as a cash inflow. I am discounting that at the last year's PV factor rate and that's it. So total 6,38,730 minus the outflow, you will get your NPV. Okay. B, they are asking payback period. When they ask payback period, means they are asking you the normal CFAT, not the PV factor wala CFAT. Okay. So here 1, 2, 3, 4, 5 your CFAT which we found out. Then we did discounting now. They are asking payback period, not discounted payback period. So you will take CFAT here. This one you will take for payback period only. Okay. So 2,17,000 cumulative you will do. Okay. Again cumulative. And then cumulative. And in the 5th year, you will get 6,06,000 plus 5th year's CFAT plus 1 lakh plus 50,000. So then this will become total 9 lakhs. Okay. In the 5th year, you are not going to get only CFAT. You are going to get your working capital also and you are going to get your salvage value for the machine also. That is why it will become cumulative 9 lakhs. Now initial investment is 6 lakhs. In the 3rd year, you have received 4,66,000. Cumulative only you will see, no? In the 3rd year, you received 4,66,000. So balance, whatever is left, you will receive it in the 4th year. But your fourth year income is how much? 1,39,800 for 12 months. So 1,33,800 will be how much? 11.48 months. It is almost like 11.5 months, 11 and a half months. So 3 years plus 11 and a half months, you will get your payback period. Discounted payback period, you take the discounted cash flows. Okay, so initial investment is 6 lakhs. Where is our discounted cash flow here? Here. You will take the discounted cash flow over here. Okay, you will total it, cumulative. So in your discounted cash flow, in the fourth year, you are going to receive 47 when you will add cumulative. In case of cumulative, you will get 47,1914. So balance you are going to receive it in the fifth year. So in the fifth year, you are actually receiving 1,66,816 for 12 months. So for this, how much time you will take? 9.2 months. Okay. Profitability index, PV inflow upon PV outflow. We found out PV inflow, PV outflow 1.0645 times. Now internal rate of return. Now internal rate of return, we will have to increase the rate of return. Why? Because we are having a present positive NPV, no? We are having a positive NPV, right? 38,730. So I need one negative, one positive. So since it is a positive NPV, I will have to increase the PV factor so that I get something less in the present value. 0 I want to make. So CF80 and years I have written everything total. PV factor 1 divided by 1.14. I'll get my PV inflow at 14%. And then again I did PV factor 1 divided by 1.16 because here also the total was coming as positive only at 14%. So I did it with 16% also. When I did it with 16%, it came negative. So one positive and one negative I want. So I'll have to do something with this 14%. Okay, I'll have to add it with 14% so that my PV becomes negative 7244. From positive I need to go to negative 7244. So see this, when PV factor we increase by 2%, how much did the cash flow increase? 7244 negative plus positive. Right, it will be 7244. Okay, plus it will be 2175. Means this profit also got written off. And no, not written off. In this profit also means it is not there, and there is another loss of 21755. So actually, what is the loss? 7244 plus 21755. Okay, don't forget. So the difference, we went below 29,000. So if I want to just go low at 7244, I want to go low by 7244. In last sum we were going up. I want to go low by 7244. So how much I will have to increase? So 7244 into 2 divided by 29,000. So 0.5 you can say. So 14 plus 0.5. Okay. 14 plus 0.5 is going to be my 14.5% will be my IRR approximately. Okay. So for internal rate of return, you need one positive NPV and one negative NPV. Okay. So when I did with 14%, again I got positive NPV, but very less amount, 7244. That means I need a negative 7244. No, now I have to reduce this. So only then NPV will be 0. So I again did with 16%, but in 16% I got a negative of 2175. Correct. So now what I will do is, I will take 7244 plus 2175. So when I went 2% ahead, I got a difference below of 29,000. I want to go low only by 7244. How much will be that? 0.5 approximately. Cross multiply. So my IRR will be 14% plus 0.5. IRR is 14.5%. Okay. Alright, come on. Now I am solving the past exam questions for you all. So this sum is also done. Past exam questions are very easy. Okay, see this, June 2024. An investor is considering to purchase a new investment at rupees 15 lakhs. So this is your outflow. Investor has two options, M and N, and their expected cash inflow is already given to me. The investor has a target return of 12%. Okay, 12% is going to be his return. But the risk premium rate is 3% for M and 7% for N. That means your external rate of return, KE, will be 12 plus 3 and 12 plus 7 for N. For M and for N. This is your targeted rate of return. Internally, you want to get 12%. This is not your cost. This is not the PV factor. PV factor will you have to even ascertain with the help of the risk rates also. So this was the only twist given here. And here they have already solved that and given to you 10% discount factors, 12.5, 15%, 18%, 19%. I am interested with this 15 and 19. Why? Because 12 plus 3 is 15, 12 plus 7 is 19. Which investment should be preferred? Okay. Option M, I will take 15%. Cash inflow given here. This is given. This is also given. Just multiply them. You will get your PV inflow. Nothing else is there in the sum. Total PV inflow minus outflow, you are getting a negative 2,65,315. So this I don't think so we can accept. Then we do option N. Option N, cash inflows given. This is also given. So you can find the PV inflow. Total is how much? 18,44,750. Okay. Inflow minus outflow. I'm getting a positive NPV 3,44,750. Yes. Due to higher NPV in option N, investor will prefer option N. Simple. So easy the sum is. But if you all do a garbad over here. So if you see 12% is not given only. They have given this no for some reason. 12.5 is given. 12 is not given also. Risk premium rates. When I am doing KE, I will take in that factor, no? So this is what was new over here. That's all. Now next question. Equipment A has a cost of 75,000 and the net cash flow is 20,000 per year for 6 years. Means same inflow for 6 years. Whenever you have the same inflow now for all the years, do that cumulative one. M plus 1. Discounted factor. Okay. There is an equipment B, cost is 50 and it will generate 14,000 per year for 6 years. So both are for 6 years. The rate of return is 11%. That means 1 divided by 1.11. What is the net present value and profitability index for both? Which equipment should be accepted and why? They have given me also 1, 2, 3, 4, 5, 6 PV factor. So you can do it this way. You can take it for each year and then multiply that by each amount. Like for A, you will have to do into 20,000 for each. What I have done is I have taken a cumulative one. See this. I have done 1 divided by 1.1 equal to M plus 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 MRC. I am getting a cumulative one, 4.231. So 20,000, because that is only easy. Why you want to sit and multiply everything? Just do this 1 divided by 1.11 and do a cumulative and get an MRC. So total of the 6 years will be 6.231 minus 75,000 for equipment A is the outflow. So NPV for equipment A is 9,620. Profitability index, inflow upon outflow. 84,620 is the inflow, 75,000 is the outflow, 1.128. Same thing for equipment B, you found out, no? 1 divided by 1.11 for 6 years. Okay, for 6 years. So now also I'll do the same thing, but the inflow is only 14,000. Okay, so 14,000 into 4.231 minus 50,000 is the outflow. And my NPV is 9234. Profitability index 59234 upon 50, 1.185. Okay, so if you see profitability index of B is higher, and NPV of A is higher. So now what you will do? You will write the comment that NPV of A is to be preferred over NPV of B, obviously. But if you see the profitability index, then project B is preferred. So now what comment you will give? If the company is having 75,000, then they should obviously take up the project A. Why? Because that will be increasing the shareholders' wealth, as the present value net profit will be more than the project B. But if they don't have that much of amount today to spend, 75, so then 50,000, then project B will be preferred. So write a comment which is going to be like satisfactory to the examiner. Okay, just don't write yes, no, A to be preferred, no B. Don't write like that. Okay, please apply your learnings in the comments. Okay, so this is it with your capital budgeting. Everything what I have done here, you all can just sit back and revise it and then solve it, after you have finished going through this entire lecture. Then sit and solve the sums. Keep my solutions in front of you. Okay, and try to solve it by yourself, and you will be able to. Only the solving part in capital budgeting is little complex. Otherwise the sums are really nice and easy, and this is what they ask in exams, and rest all is a little part of a theory. Okay, now the latest exam questions for capital budgeting. Okay, see, in FM the first 20 marks is what is really important. I tell you, in that first 20 marks are very simple. It is just the length of the question, but that first 20 marks are really easy, and the balance are some in form of little theory and some small sums here and there. So now this capital budgeting question also, which is just your recent past exam question, let us read this and you will come to know that it is again what all we have already solved, and it is the same thing. There is nothing new in which they are asking anything. Okay, so let us read this first. Vishal is a mechanical engineer with over 3 decades of experience. After completion of his graduation, he has worked in the global oil and gas industry for various companies as an employee. Given his vast experience in the energy sector, Vishal is often invited to various conferences on the oil and gas industry. Okay, this is all the history and geography which they give you. One such conference was on the areas of opportunities common to all, include the India growth story. Okay, so this story we understood. Vishal recognizes huge potential of oil and gas sector in India and sets up an engineering and construction company, Mrs. Midstream and Company, based in Kolkata. The first bid for the project is a gas pipeline for a government company. The initial outlay of the project is 575 lakhs. Okay, the duration of the project is 5 years. The expected cash inflow is as follows. So they have given us 5 years and all the cash inflows for that period. Okay, 175, 195, 190, 285, 240. The acceptable rate of return for Mrs. Midstream and Company is 15%, a discounted factor. Okay. Now Anuja, who is the CFO of Midstream, recommended a risk premium of 3% over and above the acceptable rate of 15%, considering the risk in the project. So basically now my DCF, my discounted factor, has become 15 plus 3 because there is some risk factor. So she's saying that just add more 3% to it and make it 18%. Okay. Vishal estimates the duration to recover the initial cost of the project. Anuja mentions that it would be most prudent to use the discounted cash flow for such calculation. A risk management perspective also would involve a more conservative approach in terms of the cash flow estimation. Anuja mentions that the firm needs to take more conservative estimates of the cash flow using the certainty equivalent technique with a discount rate of 15%. So if we are using certainty, then our discounted factor rate will stay 15%. Cash flow from the government project with the coefficient, certainty coefficients, are as follows. 175, 195, 190, 285, 240 for the 5 years, and their certainty coefficient ratio is given. We have to calculate NPV of this project, of the gas line bid for the government company, and we have to give the recommendations with regarding the acceptability of the project. Payback period. post payback profitability index, and the discounted payback period. Okay, so payback period, post payback profitability index, and then again discounted payback period as well. NPV of the government project after application of certainty coefficient. So we have to keep doing the same thing. Okay, that same table actually, and we have to just apply it with the help of the questions being asked, whether first question number 1, 2 and 3, all three, and all the givens are there. Okay, everything has been enumerated in the question. They have also given us the PV factor for each year, for year 0, for both, for 15% and 18%. Obviously for year PO it is 1, and then for the rest they have already given us the PV factor as well. Okay, now we are going to basically solve this entire question. So first one, okay, first is NPV. They are asking us the net present value of the gas line project. So we know that our PV outflow is nothing but 575 lakhs. It is already given to us, initial investment. Discount rate is 15, but there is some risk premium to be added, therefore it now becomes 18%. So we will have to find the inflow with the help of 18%. Right, so all the years discounted factor rate, we will take it from the question. They have already given it to us. Cash flows are also given to us. We simply multiply them and we get the answer. Okay, CF80, this is what your CF80, discounted CF80, correct? So when I will do the total, I am getting 658 lakhs 85,000. Okay, so your PV inflow minus the PV outflow, which is 575 lakhs. So I am making 658 lakhs, correct? And my outlay is only 575 lakhs. So my NPV is positive 83 lakhs 85,000. So since NPV is positive, the project is acceptable. Simple, it was, everything was given. NPV was simple. We just finished the first part. You see? So we just get scared of the size of the question. We have already completed the first part. Second, they are asking the payback period, post payback profitability index, and then again discounted payback period. Okay, so first we are going to do the payback period. Now in the payback period, we'll have to first find the okay, so the payback period, we have got the inflows here 1, 2, 3, 4. Okay, all the cash inflows are written over here. Okay, we'll have to make it cumulative. So 175 plus 195 will make 370. 370 plus 190 will make 560, and 560 plus 285 will make 845. Okay, cumulative cash inflow. Okay, payback period. So basically my outlay of 575 lakhs. Okay, it is, the recovery is already happened in the 4th year. That means the payback period has to be 3 plus some years. Correct? Entire recovered amount has happened in the 4th year. But payback period, that means it will be 3 plus some amount, some number of fraction of years. Okay, so basically 560. Okay, so in 3 years 560 is already recovered, so balance 75 lakhs I have to recover. In 3 years we are already recovering 560 lakhs. So now only balance 75 lakhs has to be recovered. So in the 4th year, I am taking 1 full year to earn 285 lakhs. So for 75 lakhs, it will be how much? Correct. So it will be cross multiplication. Okay, it will be 75, divide that by 285. Okay, just do that. 75 divide by 285. Okay. sorry, 1 second, it is not 75 lakhs, it is 15 lakhs. Okay, it is 15 lakhs, right? 575 minus 560, only 15 lakhs is remaining for me to recover. So I am recovering 285 lakhs. For that I am taking 1 year. So for 15 lakhs, how much time I will take? It will be 15 upon 285. That is going to be 0.05. So 3 full years plus 0.5. So it is going to 3.05 years is the payback period. Okay, now post payback profitability is what? Basically that the total, okay, post payback profitability is your total of your inflow minus your outflow. So what is our total inflow, cumulative inflow? Here we have, okay, so total of your inflow is 175 plus 195 plus 190 plus 285 plus 240. Okay, 1085 lakhs. This is the total inflow, cash flow. Okay, for all the 5 years, when I add them all, it is going to come as the total cash flow. So total inflow minus your outflow will give you the post payback profitability. So 1085 lakhs, okay, minus 575 lakhs, 510 lakhs will be the answer, post payback profitability. Post payback profitability index. Now since I found the post payback profitability index will be 510 lakhs divided by 575. It will be post payback profitability upon the PV outflow. This is the formulas which we have already done. Okay, and we will apply percentage to it. So it is going to be 88.70%. Okay, post payback profitability means what? That after recovering my initial investment amount, my outflow, how much yet I could make? What was the surplus I could generate after the entire investment was recovered? Okay, so basically we generated 1085 total cash flow. From that I will remove my investment. So I was able to make a profit of 510 lakhs. Now that 510 lakhs of profit I made over a capital of 575. So my post payback profitability index will be 88.70. Okay. Now discounted payback period. In case of discounted payback period, again we are going to do the same thing but with the discounted cash flows. We have already finished finding the discounted cash flows here. We have to just take it and again copy it in the next table. Okay, same whatever we had just calculated with the help of the PV factor, okay, of 18%. So we are going to just copy paste it over here. Now we see that in 4 years, see in the 5th year the entire amount is recovered. 575 and more is recovered in the 5th year. So basically your entire investment is recovered in the 5th year. So what I will see the 4th year. Recovery has happened in the 5th year. So the 4th year is 553 lakhs and 25,000. So now balance, okay, 553.25. So from 575, I'll have to remove 553.25. So only 21 lakh 75,000 has to be recovered in the 5th year, right? So I am going to take 1 year to earn how much? 105 lakh 60,000. So to earn only 21 lakh 75,000, how much time will I take? I'll cross multiply. So 21.75 divided by 100, 1056. It is going to be at 75,000, divide that by 105. Okay, it is going to be 0.21. So 4 years plus 0.21, which will be 4.21 years for the discounted payback period. Okay, so this was it with the 18% of the discounted factor. So we have already completed the part 2 of this question. Okay, so they are just going to keep you asking the same thing. You have to keep on making the same tables. Now the last one, they are saying that find NPV again, but with the help of the certainty coefficients. Now when we are going to do certainty coefficients, we will take 15% of the discounted factor. So now same table, once again, all the years, whatever cash inflows they have given me, coefficient of variation is also given to me. Nothing I have to find, everything is just given. So my certainty cash flow will be multiplication into the coefficient, certainty coefficient, right? So total PV inflow, total, okay, first I will have to find the coefficient variation of the cash flow. With that I will have to now multiply with the discounted PV factor of 15%, which is again already given to me, right? So this is the outflow. Inflow with the discounted PV factor. So the total will be, total of PV inflow is 583,61,550, right? From there I will remove my investment. Since here 8,61,550, NPV is still positive, the project can be accepted. Okay, so at your NPV of 18%, 83,85,000, and if you are doing NPV of certainty method, you are getting 8,61,550. So in both we have a positive NPV, the project should be accepted. Okay. Okay, so now let's solve another important exam question. I will first read the question and we will understand what are they actually asking. Okay, I will just give you a basic explanation of what is to be done when these type of questions are asked. Okay, so let us read the question. Tara and Company. Okay, Tara and Company is a private sector electrical engineering company that is in existence for past 4 decades. Mr. Bhushan is the founder of the company and he is the existing chairman and MD. Geeta is the finance professional and brings rich experience to the company. Currently, Geeta is a CFO of the company. Tara and Company is engaged in manufacturing, installation and maintenance of low voltage electricity cables. Their main customer base is government and private sector electrical utilities. The company prefers taking short-term projects with fast turnaround and payment cycles. Geeta is of the opinion that the change in strategy is required. The company should consider bidding for long-term projects which have potential for higher return on their invested capital and assured cash flows and known existing clients. 4 such projects are identified by the marketing team. The company has the capacity to undertake all the 4 projects if they meet the required criteria. Now, what is the required criteria? They are saying the cutoff rate of return is 18%. That is your PV factor. Okay, your discounted rate is 18%. Payback period should not exceed 6 years. So they are saying basically there will be 4 types of different projects, okay, having the cash flow of, like, the investment amount is different, but the cash flow for all the years it will be the same, but the life of each of the project is going to be different. This is that type of sum where the life of the project is different. Okay, and annual net cash flow is given and we are supposed to find out the annual NPV. Okay, because the life here is not similar. However, the cash flow for all the 11 years in case of A, if you see, is 73 crores. Okay, the amount is in crores. Investment amount also crores. So A is having an investment of 300 crores, but the life of that project A is 11 years. It is going to give me 73 crores annually. For B, it is 850 investment amount, but the life is also 18 years, 95 crores annually. Then 925 for C, 125 is the annual income, annual net cash flow, but 12 years of the life. And 250 is for D, 38 crores will be your annual cash flow and the service life is only 10 years. They have already given the PV factor 18% for 11th year, 18th year, 12th year and 10th year. Okay. What are they asking is that we have to understand which project is going to be feasible. Okay. They are going to select that project which will meet their criteria. That payback period also should not exceed 6 years. The marketing team of the Tara & Company has a plan to expand their foreign territories. There are a number of goodwill projects being undertaken by the government of India for smaller nations. The marketing team has selected 2 projects for the application. Now, this is something again different. Okay, they're talking about some other 2 projects. Alright, both the projects are being financed by Government of India and are identical. However, Geeta feels that the project with less risk embedded in cash flow should be selected. Okay, so this is one part of the question where there are 4 different projects, and then now again there is a different part of the project. Between 2 projects, whichever is riskier, we have to identify that particular project. So proposal X and proposal Y, they have the same cash flow, identical cash flow, identical number of years. Okay, 1, 2, 3 and 4. Okay, 1, 2, 3 and 4. Okay, so identical cash flow, identical years, but there is a probability assigned to it. Now, in order to know which one to select, we will have to ascertain the risk associated with both the projects. The project with higher risk will be rejected. Okay. Now, there is some additional information given over here. Initial capital deployment is necessary and 25% will be equity for that 1000 crore and 75% as debt. Interest cost is 14%, income tax rate is 15%. Let us understand what are they asking. They are asking us, we have to rank the proposal A to D according to their payback period and which proposal can be accepted. Second, they are asking, rank the proposal again from A to D according to the present value index method. What is present value index? Profitability index, which we have already done in our sums. Profitability index, which proposals can be accepted. And last, we have to find the coefficient of variation for proposal X and Y. Why coefficient of variation? Because that will help me ascertain the percentage of risk involved. Okay, I will explain you that part later. First, let us understand the first part, A and B. Okay, last part they are asking which is riskier and which proposal should be accepted from X and Y. Okay, first understanding, answer number A. Ranking of the proposal according to the payback period. Simple, they have given us all the proposal, they have given us the investment amount in crores, and they have also given us the annual net cash flow after tax and before depreciation, which we always want. Okay, so now this amount of cash flow, and this is the investment, we have to find the payback period. So basically, what will be the payback period? Simple, it will be the amount of investment required divided by the cash flow. So this amount of investment, 300 crores, divide by 73, I am going to get annually. So basically, I will take 4 some odd years, 4 point some years to complete my investment amount. I will receive that investment amount with the help of the cash flow. So my payback period for A is 4.11 years. Next is B. B has 850 CR and it is going to have an annual cash flow of 95. Simple, I will divide them. So basically, I will take 8.95 years to get my as a payback period. That means I will be able to receive all the invested amount in a period of 8.95 years. After that, whatever I am receiving, it will be my profit over my cost of investment. Then it is C, 925, divide that by 125. 925 divided by 125, you'll get 7.4 years. And last is 250, divide that by 38, it is 6.58 years. So if you see this A, B, C, D, A is the first one, okay, it ranks 1. Why? Because it is taking the least amount of years as my payback period. Means in 4 years, 4.11 years, I will have my entire investment amount recovered. Correct? So this is the one which is the best, so rank 1. Then with the least payback period is proposal D, which is 6.58. Then comes third, 7.40, and then B is the last, the fourth one. So they have already told that if any payback period exceeds 6 years, okay, they do not want to accept that. So they can accept only proposal A because that is the only proposal which is below 6 years. Therefore, conclusion is important. When you write the answers with the conclusion, it helps you score best full marks, okay, like you have completed the answer. So just don't leave it like that. Proposal A can be accepted. Why? Because the payback period for all the other projects exceeds 6 years. Okay. Now coming to answer B. Okay, now ranking the proposal as per the net present value index. Present value, net present value index method. Okay, probability. Net present value index means PV inflow upon PV outflow. That is what we do. Profitability index is nothing but PV inflow upon PV outflow. Alright. Now, okay. So now again the same table, right? We are going to have this investment amount for A, B, C, D, 300, 850, 925, 250. Annual net cash inflow is also given to us, and the PV factor at the rate of 18%. Okay, for that particular year, this was for 11 years, etc. Whatever number of years is also given to us. Okay, now what will be the present value of the cash flow? Simple, we will have to multiply the annual cash flow with the PV factor. So it will be 73 into 6.18. We have to multiply the annual net cash flow with the PV factor. Okay, it is for a period of 11 years, no, this first project. 11 years, then 18, then 12 and 10. And the PV factor for that 11th year, 18th year, 12th year and 10th year at a rate of 18% is given to us. So simply we will multiply that. That cumulative PV factor is already given to us. Okay, at the rate of 18%. For 11th year it is 6.18. That means it is going to make how much of inflow? The cash inflow will be 451.14 crores. Similarly, 95 into 19.67, 1868.65 crores. 125 into 7.29 and 911.25 CR. 38 into 5.23, 198.74 CR. So the best, okay, the best one has to be, now first we have to find the net profit value index, okay, net present value index, profitability index, which is PV inflow upon PV outflow. So 451.14 divided by 300. Okay, so this is my inflow, this is my outflow. Inflow divided by outflow, 1.5. Inflow is 1868.65 divided by 850, 2.19, approximately 2.2. Then inflow is 911.25, divide that by 925. That is going to give you 0.99. Then D is 198.74 divided by 250.79. So the best NPV index, the highest NPV index, net present value index, profitability index, PV inflow upon PV outflow is for proposal B, which ranks 1. Then comes proposal A, then comes proposal C, and then D. But here only A and B can be accepted because NPV is greater than 1. NPV index has to be more than 1, right, for a proposal to get accepted. So here A and B can be accepted because only their NPV is above 1. Rest C and D is below 1. Okay. So this was your part A and B of the sum. Now we are going to part C. Part C and D is about proposal X and Y, which has similar cash flows, same number of years, different probabilities though, okay. And they are supposed to know that which project is risky in order to see where, when, what we can accept. Okay, so here we will have to find the deviation, standard deviation and coefficient of variation. So if I tell you that base, okay, average is 100 and a particular project is changing by 30 rupees and there is one project which is changing by 20%. Obviously, so this 20% is less risky, no? If it will deviate by 20% only. This will deviate by 30%. Okay, so we have to understand the standard deviation for this particular question. Okay, so proposal X, all the cash flows are given over here. 1 second. Okay. All the cash flows are given. Probability is also given. So the average for all the 4 years, 4 plus 8 plus 12 plus 16 comes as 10,000, which becomes our mean. So the difference of the cash flow from the mean means average. From 10,000 there is a difference of 4,000 minus 6,000, right? From 10,000, that is basically I am doing X bar minus X over here. Okay, from the mean how much is the cash flow deviating? Here it is deviating by minus 6,000. Here it is deviating by minus, changing difference is minus 2,000. Here plus 2,000 and plus 6,000. As per the formula, we will have to square X minus X bar. Okay, so X minus X bar, 6,000 into 6,000 we will do. 2,000 into 2,000, minus and minus becomes plus. Okay, 2,000 again 2,000 and 6,000 into again 6,000. Okay, so this is going to become equal to 360 lakhs, 40 lakhs, 40 lakhs and again 360 lakhs. This we will multiply by the probability which is also given to us. 0.2 into 360 lakhs, 0.3 into 40, 0.4 into 40 and 0.1 into 360 lakhs. The total of that will be the total of the variance. Okay. So once we have the variance, the average is 40,000 divided by 4. Okay. That is how the mean amount has come. So once we have the variance, standard deviation of the variance is nothing but the square root of the total. So our total is how much of the variance? 136 lakhs. So standard deviation is what? Standard deviation is nothing but the square root of the variance, which here as per proposal X comes to 3,688. I have rounded up the amount. Same thing for proposal Y. These are the cash flows which is given to us. We will have to find the average. It will be the same 10,000, right? Now what is the difference from the average to the cash flow? Here it is minus 6, minus 2, plus 2 and plus 6. Same thing. This will become plus 360 lakhs, plus 40 lakhs, 360 lakhs. Now I will have to multiply that by the probability. Here it is 0.1, so 36 lakhs, 0.4 into 40, 16, 0.2 into 40, 8 lakhs and 0.3 into 360 will be 108 lakhs. So my variance, the total is going to be 168 lakhs. So for proposal Y, standard deviation also will be equal to square root of that variance, which is 168 lakhs, which is coming to 4099. Okay, 4099. Now this is the standard deviation. Now this much of amount is deviating from the average, which is 10,000. So what is the percentage of risk? This amount is deviating from the average. This is the amount of deviation which is happening. So coefficient of variation will be the standard deviation upon the mean x bar into 100. This has to be in percentage. Risk amount is always like in form of percentage. So this is 36.88%, and for proposal Y it is 40.99, approximately you can say 41% also. So obviously looking at both, Y is deviating more, okay, from the average, hence it is more risky. So at the time of bloom, okay, then there will be good amount of but if there is some kind of a period where there is losses incurred, then the deviation of that loss also will be that high. Okay, so this project is risky. So proposal X, the coefficient of variation 36.88, Y it is 40.99. Proposal Y is riskier, therefore proposal X should be accepted. And the final summary, payback period ranking, as per that proposal A should be accepted because it has a payback period of less than 6 also, least payback period. As per net profitability index method, B and A can be accepted. B has the highest NPV. Proposal A and B are acceptable under the first NPV index method. And coefficient of variation X and Y, where Y is riskier, therefore proposal X should be accepted. Okay. So though this sum looks like, okay, there is a lot of things to be solved in this, but if you see, it is all the same table again. You had to just understand what are they asking. Okay, first it was very simple. They were just asking you payback period. 11 years, the number of years is given, investment amount and annual net cash flow is given. So annually that same amount of cash flow is being received. So how much years you will take to finish and receive your investment amount. Second, they are asking you profitability index, PV inflow upon PV outflow. Outflow is already given. PV inflow we have to find with the help of the cumulative PV factor. Right? Based on that, you will rank it. And the last one is X and Y, about standard deviation. How much is the variance happening? With the help of the variance, we are able to find the standard deviation. Standard deviation enables us to understand the coefficient of variation, the percentage of risk, where Y is riskier than X. Okay. So with this, we have completed our capital budgeting. Thank you everyone. So now let us begin with another chapter, and that is security analysis. Okay. All right. Security analysis. This also I am just going to do it from the exam point of view. All the important, there are a lot of types. If in case you all have seen my dream lectures, okay, dream class, dream batch, in that my all these lectures are there. So it is all, there are a lot of types. They are very small sums, but there are many types of things in security analysis. Why so? Because actually security analysis is a very practical chapter. If tomorrow you want to go ahead and you want to do investments, okay, in a given company, you want to understand your expected returns, compare that with your actual returns, whether you should invest, whether you should sell, hold, all that has become a very important stuff for investors. Okay, so security analysis is now like it is gaining importance as a chapter also. Okay, so hence I have taken, there is a lot of theory as well in this chapter. Okay, there are certain concepts to be explained in this chapter, so you will have to do the theory as well. Okay, now first part, Okay, part 1 of this chapter is all about capital asset pricing model. Okay, security analysis, if you will see, part 1 is all about capital asset pricing model, which was developed by this Mr. William Sharpe in 1964. Now, what is this capital asset pricing model? I'll tell you one simple example. Say today you are investing your money. You have 1000 rupees and you have kept it in the FD, which is giving you a return at 10% and you are very happy. Okay, per annum. But your portfolio manager is telling you that, sir, you are keeping this, sir or ma'am, you are keeping this 1000 in FD and getting 10%. Rather keep this 1000 in the market. Okay, you are going to get a return of good 18% per annum. So I will to say, Arey wah, very nice. 8% more I will get in the market. Instead of, then why should I keep it in the FD? Just let's remove this 1000 from the FD and keep it in the market. But no, FD is for those people who do not want to take any risk. It is a risk-free security. Risk-free, 10%. You don't have to worry about anything. Every year you will keep getting money. But market is fluctuating in the nature. 18% is there. But there is lot of risk factor which is associated to it, which is known as a beta. Beta is your risk. So in order to get this extra 8%, no, from 10 to 18, this is my premium, no, 8% premium I am trying to get more. Is not 8% actually, it has to be factored with the risk. That is why here, whenever we find the rate of return, okay, from a given portfolio, we need to understand that your expected return is your risk-free rate of return. This 10% you will get only. Plus, you need this no extra. RM minus RF. Market rate of return 18 minus 10. That means you are expecting no this additional of 8%. But this additional of 8% is associated with beta. Say the beta for this type of securities is 0.2. So you are not going to get 8. Correct? No, you are not going to get full 8. There is certain thing which is there, which is associated with it. No, there is a risk associated. So you are going to get additional of 1.6. So that is how you will do an analysis of a given, portfolio, whether you would like to invest it or not. It is not straight away premium of 8% extra you are going to get. Okay, there are a lot of things which is attached to it. So expected return as per capital asset pricing model, this is the formula. Very easy formula, RF plus beta into RM minus RF. If your expected return, you are comparing that with your actual return, then only you will be able to understand whether you want to buy, you want to sell, whatever decision you want to take as an investor. It will be with the help of this ER and AR. Okay, let us take some further example. There are 4 portfolio managers who have created their own portfolio, right? There is a return on market at 10%, risk-free rate of return is 6%. Select the best portfolio manager. Now you have to select, okay, there are 4 portfolio managers and the actual return they are going to give you is 11, 10, 14 and 13. Beta also they have given me. So I have beta, I have RM, I have RF. I can find my ER. What is ER? ER is nothing but RF plus beta into RM minus RF. Once I get my ER, I'll compare that with my AR and then I'll be able to understand which is my best manager. Whom should I go to? Okay, so see this. Okay, market risk is a return on market. It is also known as a premium, risk premium. They will use these type of words in the question. Okay, so your RM minus RF is known as your risk premium. So type 1, okay, give it. I've written the give it. Return on market, return on risk-free securities, and so therefore RM minus RF Risk premium is 4%, no? 10 minus 6, right? Now manager A. For manager A, ER will be 6% RM. Beta is given as 1.5 for this, 1.5 into 4. So 1.5 into 4 is 6%. So 6% plus 6%, 12%. And expected return is 11%. So I can say since the expected return, okay, is 12%, it is greater than the actual return. That means this particular stock or anything is overestimated, overvalued, right? So if it is overvalued, I'll not accept it because I'm not getting that much of return as I'm expecting now. Then for manager B, beta is 0.8, everything else remains the same. Because of beta being 0.8, your ER has now become 9.2. Expected return is 9.2. Okay, with this particular manager. But he is giving an actual return of 10%. That means this is undervalued. Undervalued, so you will accept it. Manager C, again the beta has changed. Everything else remains the same. Your ER is 14.8% and actual return he is giving only 14%. Again overvalued. You will reject it. And then the last is 1.8 as beta. You have to just substitute it in the problem. So 6 plus n plus 7.2, 13.2 is your ER. Expected return is 13%. Actual return is 13%. Expected return is 13.2. Since again ER is greater than AR, I'll reject it. Why? Because it is overvalued. So only manager B, who is giving me more returns as compared to my expected returns, I am going to accept him. Okay, expected return is more than your actual return, then it is overvalued, you will reject it. And if your expected return is less than the actual return, it is undervalued, you will accept it. This is the rule. Okay. Now question number 2. Same thing again. There are stocks A, B, C, D. There are actual returns which are given and they have given you the beta. They have given you RF and they have given us RM. Okay, so my risk premium is going to be 5 RM minus RF. Right, so which are overvalued and undervalued we have to find out. Let's make a table. Okay, RF, RM, RM minus RF is 5%. Okay, expected return for stock A. What is the formula? It is RF plus beta RM minus RF. RF for A is 10. For A and everything remains same, only the beta is changing for all the stocks. 10% plus 1.3 into 5. Okay, that will be 6.5. So 16.5 is the ER. Actual return is 17. It is undervalued, so we will accept it. For B, beta is 0.8. So everything else will remain the same. 0.8 into 5 plus 10. 14% is the ER. And AR, actual return is 14.5. Accept it. Undervalued. Stock C, beta is 1.1. So 1.1 into 5 will be 5.5 in plus 10. 15.5 is your ER. And 15.5 is your AR also. So it is correctly valued. You can accept it. And D, beta is 1.7. So your ER is coming up to be 10 plus 8.5, 18.5. And AR is only 18%. It is overvalued. You will reject it. Okay, so this type of sums are asked in this particular chapter. Okay, now see this. XYZ stock again has a beta of 0.9. Expected return of 13%. Okay, so ER is already given to me. The market expected return RM is also given to me. We have to find RF. So we will just put the same formula. We will put this only formula. RF plus beta RM minus RF. We need to find RF. So RF, say it is X. We can just put it in the formula and find it out. Beta is given. Expected return is given. RM is given. Okay. Don't put the percentage signs, you will get confused. So expected return is 13.585 given. RF we are finding, beta is given, RM is also given, RF we are finding, right? Keep this as it is, keep this as it is. 0.95 into 14.014 multiply, you will get 13.3133 minus 0.95 into RF will be 0.95 RF, right? This 13.3133, take it on the other side. So 13.585 minus 13.13 and 1 RF minus 0.9 RF will be 0.05 RF. This you will subtract, you will get 0.2717, divide that by 0.05, that will be your RF. So your RF is 5.434%, approximately 5.5%. Okay, do it 0.2717, divide that by 0.05, yes, you are going to get 5.434, you can say approximately 5.5. So your risk premium will now be market risk, which is given, RF which you found out. So your risk premium is always RM minus RF, I told you, 8.514. Okay, now they are saying if RM is 17%, find the expected return. This is the C question. Okay, so expected return, okay, RF we just found out 5.5. Beta is also given to me. Now I will say RM is 17 minus 5.5. I'll do, na? Don't put percentage signs, okay? Otherwise you are definitely going to get confused. Don't put these percentage signs. Put the percentage signs at the end. So 5.5% you will keep doing. 17 minus 5.5 will give me 11.5. This 17 minus 5.5 will give me 11.5. 11.5 into 0.95 will give me 10.925. So 5.5% plus 10.925%, it is going to be 16.425% your expected return. Okay, so all three are solved. What is RF? We found out. What is risk premium? RM minus RF. And if actual return, okay, is 17%, what would you now expect from the stock? Actual return from the market is 17, then what is you going to expect from the market? So we have to just again put the formula. Everything revolves around this formula. There is nothing much to it. Okay, now what will happen is this formula, which is your ER, is also used to find your cost of equity. You remember in cost of capital I had told you that this particular CAPM I will do it when I will do security analysis. So cost of equity, one was dividend upon price, right? One was earning per share upon market price. Another formula was dividend upon market price plus the growth. And there was the fourth formula, CAPM, which is nothing but this. K is nothing but RF plus beta, RM minus RF. Okay. Then if in order to find out, see there was this also, no? D1 upon P. If market price is not given, then we take PO plus growth. So in order to find the price, I can say in order to find the price with the help of this formula, say I do KE minus G, D1 upon PO. So now I take the price on the other side and I say D1 KE minus G. So I'll be able to find the price also. This is the derivation of the formula. Nothing new, okay? Don't say that this is a new formula. It's the same thing. With the help of this formula, we can also find the price. So now they have given me everything. RF, RM minus RF, beta, D0 they have given me, and growth rate is 5%. If they have given me D0 means I can find no D1. D1 will be D0 plus the growth rate. D0 is 3 plus 5%. So 3.15 will be my D1. Okay. Calculate the expected market price. If actual market price is 34 rupees, what investment action should be taken? So now these type of sums are important. So first we will have to learn to find the market price. For market price, I will need my KE because I need this formula, na? This formula, na? For market price or price, I will need KE. You put PO, you put market price, one and the same thing. So how will I find my KE? With the help of ER formula. Very easy. KE will be RF plus beta minus RM into beta into RM minus RF. RF they have given me, beta they have given me, RM minus RF also given me. KE is 8.2. Now I can put this formula. KE is D1 plus price plus growth. So 8.2. D1 will be D0 plus growth upon price plus growth. Okay. So 8.2, 3 plus 5% upon price plus growth. Right? Here. So now this 5% I am taking it on the next side. 8.2 minus 5%. 3.15 upon PO. So PO will be equal to 3.15 upon 3.2%. 3.2. Don't forget to put percentage now here. Huh? It will be 3.15 divided by 3.2%. So 98.43 is going to be your base price, fundamental price of the share. And actual market price is 34. Means the fundamental price is really nice based on their fundamentals. And in the market this is available at 34 rupees. We should go and invest. Tomorrow at least it is going to definitely rise. Okay, so this is how we find the price of the share. Next is investor is holding 1000 shares. Presently he is paying dividend, he is getting paid a dividend of 2 per share and the share is sold at 25 in the market. RF and RM is given. Beta is given. Expected growth rate is given. Whether the investor should buy, hold or sell the shares. Okay. So first I will do my KE. RF is given. Yeah, RF is given here 12%. Market premium, that is RM minus RF, is also given. Beta is also given. So KE is 20.4. Now I'll put this formula. K is D1 upon P0 plus growth. So KE is 20.4%. How will I find D1? D1 will be my current dividend plus the growth rate, 2 rupees plus growth rate is 5%. So 2 plus 5%. Everything else and growth rate also I'll write it here. Now this growth rate 20.4% minus 5% I'll do it here. And 2.1 upon price. Now price will go on the other side. 2.1 divided by 15.4%. Price is going to be 13.64, which is the fundamental price. Fundamental price is really low. Market, it is still selling at 25 rupees. Sell it. You will earn money now and go off from the market with this particular stock. Right? Fundamentally the stock is running really low and in the market you are getting a good amount for it. So you will obviously sell the shares. Okay. So this also question done. Okay. Now there are 3 companies. A portfolio manager has 3 stocks in his portfolio and he has invested in these 3 stocks: X Limited, Y Limited and Z Limited. Beta is also given. Expected return on the market portfolio is 15%. Okay, that means RM is 15% and RF, risk-free rate of return, is 6%. Based on the CMP, calculate the ER of the entire portfolio and then the expected beta of the portfolio. First we will find the ER. Okay. Total 3 companies investments. Total amount I invested is 10 lakhs. What are the weights? 0.6, 0.3, 0.1. Right? Beta of the stocks will be the beta of the portfolio. How will I find the beta of the stocks? Wait, why did I do this? Because I need to know the beta of the portfolio. So beta of the portfolio will be beta of each stock. So beta, weight of A into beta of A, weight of B into beta of B, weight of C into beta of C. They have given me the beta of each stock. I need the beta of the entire portfolio. Right? So I will do weight of A. I have found out 6. They have given me beta of A means beta in the X company. Okay, so weight of X into beta of X basically. Weight of Y into beta of Y and weight of Z into beta of Z. Okay, so weights I found out. Beta is already given to me by them. Given. So when the beta of the portfolio has to be found out, you will have to apply this formula. Beta of the portfolio is the weight of each stock into the beta of that stock. Simple. Add all three. If there were 4, I would have done 4. 2, then I would have done 2. So I will add all of them. I'll get the beta of the portfolio, which is 1.29 for entire portfolio. Now I got this beta. RF they have given me. RM minus RM also they have given me. Beta I just found out. So ER is going to be 6% plus 11.61, 17.61%. So this is a little different type of a question wherein you have to find the beta of the portfolio. For beta of the portfolio, you need to find the weights and apply that with the beta of the each stock. Simple. Okay. Now there is one last question. Then we will go to the past exam questions. Calculation of RM and other similar sums. Okay. Your client is holding the following stocks: Company A, Company B, Company C and some PSU bonds. Purchase price, dividend and expected market price after the year and beta. Assume the risk-free rate of return is 15%. Calculate the ER using CAFM if the shares are held for 1 year. Okay. So we have to first rate of return. Okay. Rate of return, dividend plus capital gains upon investment. Okay. So rate of return is market return, which is RM. Okay. Client's rate of return. Rate of return is nothing but whatever market is going to give you. Right. So rate of return, dividend plus capital gains upon whatever investment you have done. Because whenever you invest in the stocks, what you will get? You will get dividend. And next what you can get is when you sell it, you get some profit. So that is your capital gain upon your investments. Okay, so total dividend which we have got over here is 800 plus 800 plus 800 plus 3400 total. Total of my dividend is 5800. Okay. My capital gain. Okay. Capital gain, I'll have to compare my purchase price and my expected market price. So 200 rupees for A, then 500 rupees for B, then 22,000 minus 16,000, 6,000 it is for C, and for PSU bonds it is 34,000 minus 32,300. 1,700 I'll have to subtract. It is a loss. Okay. So 200 plus 500 plus 6,000 minus 1,700. 5,000. Okay. Capital gains means what I have done is I have done total. So 73,000 minus 68,000 also is going to be 5,000 only. But I have done a total of this. That is 73,000. Do a total only, that is the best, and total of this which is 68,000 and total of this which is 5,000. Do a total of all purchase price, dividends and expected price. So this is going to be your capital gain will be your market price after 1 year minus your purchase price which you had paid. Okay, so 5,800 plus 5,000, divide that by 68,000, your current investment. So your return, okay, rate of return or market rate of return is going to be 15.88%. Now with the help of that you will be able to find the expected return for company A. Okay, 15% RF is given to us, beta also given to us, RM we just found out, minus RF again given to us. So we had to first find this. How we would find this? We will find it with the help of the rate of return formula. What is rate of return? Dividend plus capital gains upon your total investment. That is your RM. Okay. So for company A, company B, company C, and for your PSU bonds. Okay. So your average rate of return will be the sum of ER for all. You will sum it up. Okay. You will sum up 15.704, 15.616, 15.44, 15.85. Total will be 62.64. How many securities? 4. So your average rate of return is somewhere between 15.66 only. See. Okay. Now your past exam questions. These are the other types, okay, parts of your security analysis. There is a share price of P Limited. It is trading on NSE and they have given me the sessions and the price. Okay, 14 sessions and 14 prices are different session, and they have given me this. They are telling me calculate the relative strength index from the above data. Now relative strength index, what is the formula for the relative strength index is average gain per day, divide that by average loss per day. First you have to find the relative strength. For relative strength index we need the relative strength, because then relative strength index, the formula is 100 minus 100 divide by 1 plus your relative strength. This is the formula. 100 minus 100 upon 1 plus relative strength. Relative strength is important. Now what is relative strength? Average gain per day upon average loss per day. Now relative strength index is a reading which is given on the market. Okay. Reading on the market means what? If you are this RSI has already crossed, okay, reading of 70 or above, that means it has been overbought. So now it is not the right time again to buy. Okay, and if it is below 30, reading is 30 or below, then it is oversold. Okay, so we have to see whether what is the reading of RSI, whether it is 70 and above or whether it is below 30 and below. If it is 70 and above, it is overbought, and if it is 30 and below, it is oversold condition. With the help of this particular question, they are asking me comment if the share is overbought. Okay, so for that I will have to first find my relative strength. How will I find my relative strength? Average gain per day upon average loss per day. Okay, so this is sessions given for my one stock for that day. So first I will write all the stress sessions, trading 1, 2, 3, 4, 5. Share price I will write, gain in one column and loss in one column. Okay. So in the first session, obviously no gain, no loss. I'll start comparing with the second session to the first session. Now in the second session, it became 4254 from 4344. Obviously loss of 90 rupees. Then again it went down by 43 rupees. Then from year to year, it went up by 97 rupees. So I'll write it in the gain side. From 4308, again it went up 4487. So again. Then it went to 4213. So there was a loss. So 274. From 4213, 4240. Gain of 27. Yes. Again it has gone down. So loss of 128. You have to just do minus. 4240 minus what? 4112. 128 is a loss. It is going down, no, the price. Again it went down. From 4112 it went to 4061. So what is the difference? 51. Then it went up. What is the difference? 353. Then again it went down by 384. Again it went up by 306. Again went down by 106. Again went up by 162. So how many times did it do gain? 1 time, 2, 3, 4, 5 and 6 times there was gains. So total them all. Total will be 1124. Total everything 162 plus 306 plus 353 plus 27 plus 179 plus 97. Yes, 1124 is the total. Divide that by 6. 6 times there was gain. So 187.33 average gain per day. Similarly, how many times did it make loss? 1, 2, 3, 4, 5, 6, 7, 7 times. Okay, so total that and divide that by 7, 153.71 average loss per day. So average gain per day I got, average loss per day. So my relative strength is 1.219. Now put this in the formula. Okay, put this in the formula. 100 minus, and solve this separately. 100 upon 1 plus what is the relative strength index? 1.219. So 100 divide that by 2.219. It will be 100 minus 45.065. So it is coming as 54.93. So now 54.93, if the reading, if it is 70 and above, I can say it is overbought, and if it is 30 and below, I can say it is oversold. So here hence the share is not overbought because the RSI is below 70 only still. So I will not say it is overbought. So hence we will not say that this particular stock is overbought, because if it would have crossed 70 RSI, I would say it is overbought. Okay. Then what is a systematic risk and describe its types? This you can read it. I have given you interest rate risk, market risk, purchasing power risk. Then what is price rate of change and advance decline ratio? Price rate of change is nothing but your current price minus your historical price upon your historical price. How much has your price changed? So currently if your price is standing at 100 rupees and you had bought the stock at 50 rupees, okay, into 100, you have to find the rate of change. So how much it has changed? 50 divided by 50%. 100% it has changed. Okay. Then average declining ratio. Now average declining ratio again is an indicator. Okay, it indicates, okay, whether the stock is advancing or declining over a given period. So if your advance decline ratio is greater than 1, okay, it means that the stocks are advancing more than declining. That it is a strong overall market sentiment. It is a bullish trend. Market is going up. But if your average declining ratio is less than 1, that means it is a bearish trend. Market is going down. What is the formula of average decline ratio? Number of advancing stocks upon number of declining stocks. So this ratio has to be either greater than 1. So then it is a bull. If it is less than 1, then it is a bear. Okay. Next is your Aron indicator. Aron indicator is again a technical indicator like your advanced decline ratio, RSI, everything. These are all technical indicators. They identify the changes in the price of that particular security, okay, or that asset. Indicator measures the highs and lows between over a period of time, that how many times it went high, how many times it went low. Okay, so this indicator consists of an Aron upline which measures the strength of the uptrend, and Aron downline which tells you about the downtrend. Okay, it was developed by Tushar Chande in 1995. So what is the formula for Aron up? 25 days. It is a period of 25 days minus period since 25 period high. Okay, period since 25 period high. Okay, so say the stock was high for good 15 days. Divide that by 25 into 100. Okay, and if I tell you again for down, I'll tell you that the period for which since 25 it was low. So it was low say for 10 days in that last 25 days. So this is going to be, it is a benchmark is about 25 days. Okay, so it will, this is arrow up. It was up for 15 days. So I'll take 15 days, and arrow down, I'll tell you if it is down for 10 days, you will take 10 days. So 25 minus 15, 10 divided by 25%, 40, arrow up. Okay, 40 days, 40%. And here it is going to be 25 minus 10 divided by 25%, 60%. Okay, new highs and new lows about this, and this is all there is also there in my this dream batch where I've solved certain sums also on this. Now Hamada equation. Okay, Hamada equation in explain Hamada equation and also calculate Hamada coefficient using this following information. They have given you debt equity ratio, which is 0.65 upon 1. Tax rate is 35%, and unlevered beta, unlevered means a company where there is no debt, is 0.8. Okay, so now what is a Hamada equation? It is again a method of analyzing a firm's cost of capital, and where they are using an additional financial leverage, borrowing money. Okay, so it is drawn upon the Modigliani-Miller theorem on capital structure. The higher the beta's equation, higher risk. Okay, so the more the beta, the more the risk in that company. So in order to find the beta of the levered, you will do beta of unlevered into 1 plus 1 minus tax rate. Okay, 1 minus tax rate, and multiply that by the debt equity ratio. Okay, so unlevered beta is 0.8. 1 plus 1 minus tax rate is how much? 1 minus 0.35 is my tax rate. Multiply that by 0.65 is the debt equity ratio. Okay, so 1 minus 0.35 is 0.65 into 0.65. Okay, this 2 I'll multiply first. So 0.80, 1 plus, this will be 0.65, 1 minus 3.5 into 0.65, it will come as 0.4225 plus 1 into 0.8, it will come as 1.138 when you will solve. It means the financial leverage of the company increases the overall risk by the beta. Okay, it was only 0.8, no, unlevered. Now it has become 1.138. So how much it has increased? It has increased by 0.338. Therefore, the beta of the coefficient rises. The associated risk of having higher beta also rises. So first it was unlevered, it was 0.8. The moment it has become a beta of levered, it has become 1.138. That means how much the beta has risen by 0.338. The more it is the beta, the higher the risk. Okay, so this is it with all the exam questions, past exam questions for security analysis. So security analysis for the sums, solve those which I have done right now, and pay attention on this theory sections: relative strength index, average declining ratio. Okay, I am mentioning again, relative strength index, average declining ratio, advanced declining ratio, sorry. Then you have your price change, rate of price change. Okay, price rate change you can say, a Hamada equation. Okay, so all these are also part of security analysis. So do all this as well. Okay, from your, I've done everything. In case you all have not got my notes, or you have not taken dream batch and attending only this as a lecture, so from the module only I have taken up all the sums for these particular other theory sections also of this chapter. Okay, so this is it with the security analysis. Do well, all the best, read your sums properly, Okay, take the given from the question properly and then put the formula and attempt it. You are not going to go wrong. Okay, so do well, and again, once again, a very all the best and all my blessings with you all. Solve the paper calmly, and we shall meet again after your exams. Take care, everyone. Bye.